Good morning, everyone. Jerry Boyle is my name, Director of Teagasc, and I'm delighted to welcome you all to this year's annual review and outlook with a difference. I know it's a very important event in Teagasc's calendar, and we hope you'll benefit from this morning's session. Now, today is a very momentous day, I suppose, in many respects. We're coming out of lockdown. Some of us indeed can manage to get a haircut. I'm certainly looking forward to that. And I think in many ways it's an appropriate occasion on which to venture into some consideration of the future as far as the sector is concerned. Now, we have a lineup of speakers that will deal with various enterprises, and also we will be looking at an overview in terms of sustainability, which are cuts across all enterprises. And the most important thing I'd like to say to you all this morning is we would like and really welcome your participation. So I'm asking you to use the question and answer chat function as often as you care to throughout the entire session. We'll take one or two questions after each contribution, and then we will also take a question at the break, which is at 11 o'clock. We'll take questions during the break, but at the same time, of course, you can all avail of, I'm sure, of a well-earned cup of coffee at that stage. And immediately after the break, we'll be commencing with the review and outlook story as far as the beef sector is concerned. Then at the end of the session, you will have another opportunity for questions. We'll have hopefully about 20 minutes or so. But I want to assure all of you that any questions that we don't address during the session this morning, we will handle them on our website afterwards. So I really encourage everyone to use the Q&A or chat function facility. So with those few remarks, it's over to our first speaker, and I'll let the speakers introduce themselves. Okay, thank you. So, who's up first? Trevor.
Yeah.
Trevor Donlan.
Good morning, everybody. I'm going to just take you, my name is Trevor Donlan, and I'm going to take you through just a brief tour of the macroeconomic situation and outlook, which is always something that we need to keep in consideration when we're looking at these issues. So obviously we're going to be hearing a lot about COVID-19 over the course of the morning, and it's fair to say that COVID-19 had a fairly significant effect on the global economy in 2020. In anticipation of 2020, the view was that international growth was going to slow down somewhat, but nobody foresaw obviously the dramatic impact that coronavirus would have in terms of growth rates globally, particularly in Europe and in the Americas, and we'll come back to that in due course. But I'm going to turn first to just a brief discussion of exchange rates and oil prices. Exchange rates, given that Irish agriculture has a high export dependency, are quite important. Looking at sterling first initially, we saw a slight weakening of sterling in 2020. The rate was a little bit volatile, so we saw periods where sterling dipped below 90 pence to the euro. But for the year as a whole, the average looks like being around 89 pence to the euro, which is not in any way different to the average for 2019, just about a 1 pence difference in the exchange rate. Where we go next in terms of 2021 will depend to some extent on how the Brexit negotiations play out. We'll hear more about Brexit in the next presentation. Difficult to be sure to what extent a positive or negative outcome from an Irish perspective with respect to Brexit is baked into the futures market in terms of exchange rates at the moment. So, you know, we could have more weakening of sterling next year in the absence of a trade deal. Equally, you could take a view that if a trade deal does take place, sterling could arguably strengthen. Difficult to be sure how much movement we'll see in the exchange rate next year. Looking at the dollar, again, weakening of the currency against the euro in 2020. As the year progressed, in particular, the US dollar weakened. So on an annual average basis, the dollar lost about 2 cents against the euro, but the spot price at the moment is up around 119, 120, that kind of territory. So if we stay there into next year, then that would represent a fairly significant weakening of the US dollar versus the euro, the 2020 weight for the euro. And finally, looking at oil prices, one that I'm sure we'll all be quite familiar with, given what we saw happening to fuel prices and fuel usage, certainly in the period of the initial lockdown back in March, April time. We saw a dramatic collapse in the price of oil. We're looking at monthly prices here, but there were actually, if you looked at the chart of daily prices, there were actually instances where the price actually fell below zero, believe it or not. But we did see prices dip down into the low 20s in both euro and dollar terms for a period. And then we saw a rebound into Q3. But as you can see here, prices have not at all recovered to the level they were at pre-COVID. So we're talking about an average oil price in 2020, probably of around $41, $42 per barrel compared to 64 in 2019. The futures market has been quite volatile in the last week or two, with prices fluctuating anything from $45 to $48 for next year. That's a typo there, that should say 2021 forecast, in fact, $45 to $48. So, you know, a little bit of an increase in the oil price next year, but nothing dramatic, and prices to remain well below the level they were at pre-pandemic. We move to the Irish economy, and it has been very much a tale of two economies, and I'll explain what I mean by that in a moment. We've seen a contraction in both GDP and GNP, and these estimates here are from the ESRI in their September quarterly economic commentary. The ESRI will have a new commentary available on the 17th of December, I believe. And, you know, so these growth forecasts may be amended slightly. But at the moment, we're talking about a GDP drop of less than 2%, and in the case of GNP, in excess of 2%. And we'll see in a subsequent slide that these reductions are actually quite small when compared with other countries in Europe. So while we've seen a relatively small reduction in economic activity as measured by GDP or GNP, obviously there's been a very substantial increase in the unemployment rate. If we adjust the unemployment rate to include people on the pandemic unemployment payment, then at present unemployment rates are up at around the 20% level. And for 2020 as a whole, the unemployment rate is likely to exceed the peak in unemployment we saw of 15.1% back in 2012, following the global economic crisis and the subsequent contraction that took place. So, you know, we're talking about quite a substantial drop in unemployment in 2020, whereas in fact, at the beginning of the year, we in fact expected employment to increase. And I said it was a tale of two economies, and what I mean by that is that when you look at economic activity in the Irish economy, the sectors which are dependent on domestic activity, such as distribution, transport, arts and entertainment, have suffered very considerably, whereas some elements of the manufacturing sector have actually prospered, notably electronics, healthcare, those type of sectors. Anything to do with ICT, obviously, Zoom being the future of everyone's lives these days. And even closer to home, in terms of the topic of today's discussion, agriculture and food processing has proved to be very resilient, and obviously the public sector as well has continued largely unaffected, albeit with people working from home rather than in an office environment. So a very uneven impact across the economy overall, with agriculture and food processing actually escaping the worst effects. And that wasn't something that people anticipated, I think, initially when the pandemic hit. Just looking at that unemployment rate figure there, you can see unemployment spiking up at around 30% there. You can see two spikes, in fact, the initial spike for the first lockdown and a second increase taking place more recently, coinciding with the second lockdown that we've just exited today. So we will see the unemployment rate dropping back over the rest of the year. But as I said, the average level of unemployment in 2020 is going to be a little bit higher than that peak we see there back in 2012 on the chart. So if we look at the Irish economy in summary for 2020, export performance has been quite resilient. And because we are a small open economy, that has proved to be very important. You know, the impact of the contraction in domestic consumption and investment, which was quite sharp, hasn't quite had the same impact on the Irish economy as it has, for example, on the UK economy. Given that people are spending less, imports have also fallen. And obviously we've seen elevated expenditure in respect of healthcare and also to fund the pandemic unemployment payment. But on the positive side, the decline in tax revenue has been less severe than anticipated, and that applies both to income tax revenue and also to corporation tax. Now, I mentioned that Ireland hadn't done as quite that badly when we look at GDP or GNP type measures. So this chart here just is a forecast for the European Commission in respect of EU member states and from the Office of Budgetary Responsibility in respect of the UK. So these are forecast changes in GDP in 2020 versus 2019. So I've just picked a selection of EU member states here and added the UK as well. And as you can see here, Ireland, amongst the countries I'm showing, is forecast to have the smallest reduction in GDP for the reasons that I've already set out there. And you can see, for example, by contrast, the very sharp reduction taking place in GDP in the UK this year. So Ireland, I think, amongst the EU member states, is forecast to have the second smallest reduction in GDP in 2020. Looking to 2021, prospects are difficult to call due to a couple of aspects of short-term economic uncertainty, one of them presented by COVID-19. At some point next year, this vaccination process will presumably roll out, and the economy will have to be weaned off the COVID-19 support measures that exist at present, and difficult to know how exactly that will pan out, whether there will be further lockdowns required, for example, is not something that we can say with any certainty at this point. The other big uncertainty that's more Ireland specific is Brexit, and we have two alternatives in terms of how 2021 could develop from an economic growth perspective. In the first case, where a where a free trade agreement could be agreed, we might have a 6% increase in GDP. And in the context of a no-deal Brexit, we would still see some economic growth of the order of 3.3%. And these, again, are September forecasts from the ESRI, which will be subject to some revision later this month. These look like relatively large increases in GDP, but again, you have to remember these are against a contraction in GDP taking place in 2020. And I think that's it. And with that, I will pass you back to our chair.
Thanks, Trevor. And that was an excellent overview of the macroeconomic context. And several occasions during Trevor's presentations, he alluded to Brexit. And now my colleague Kevin Hanrahan, who is head of our Rural Economy and Development Programme here at Teagasc, will talk to you about Brexit. Kevin.
Well, good morning, everybody. Just get the screen up, and lovely to join you this morning. And I'm going to just talk about Brexit assumptions and our income forecast for 2021 before we get into the detail at an enterprise level that will follow shortly. And as the director and Trevor have hinted at, Brexit is a massive uncertainty. It's a massive challenge, and we know some stuff and we don't know a lot. Okay, what we do know is that there hasn't been an agreement yet between the UK and the European Union, and everyone is watching their phones and reading newspapers probably more than they need to about what's going on in terms of this ongoing negotiation. It seems that an agreement remains possible, but as we run into December and towards the end of the transition process, the probability of a no-deal outcome is probably increasing marginally. Everybody in official circles remains convinced that if we can get a political agreement, that the ratification challenges both in the UK and within the European institutions and across the member states can be sort of solved somehow. There are some legal voices that point to difficulty in making that work, but let's presume that it can. And I've been at meetings with people from Foreign Affairs who've said that they will move might and main to ensure that if a deal is made, that it can be legally ratified. So let's all hope that we get a deal. But when we faced into our task of making forecasts for 2021, we had to make an assumption about what kind of trading world we would be in 2021. We have to make an assumption about the political world, unfortunately. So what we've done is we've assumed that for the purposes of our forecast for 2021, that there will not be a deal agreed between the European Union and the United Kingdom. We've assumed that the transition period will end at the end of this month, and that at a minute past midnight Brussels time, the 1st of January 2021, the European Union and the UK will be treating each other as third countries in terms of the WTO rules. So that means that UK exports to the European Union will be subject to the European Union's most favoured nation tariff schedule, and EU exports to the UK will be subject to the UK's announced global tariff schedule, which they announced in May of this year, and that there will be no preferential market access granted by either party to the other, and there will be no preferential access for the UK to European Union tariff rate quotas, for example, and there are no tariff rate quotas granting the European Union preferential market access within the UK global tariff schedule. So that will be really, we'll be working on a very lowest common denominator trade regime between the two parties. So that's what we've assumed next year. Okay, so tariffs and the non-tariff barriers that will be imposed on trade in both directions will negatively affect import demand for UK goods in the European Union and for European Union goods, including Irish goods, in the UK market. And this lower import demand will be reflected in changes in agricultural output prices in Ireland. Now, this is a 1-year forecast in terms of how we look to outcomes in 2021. So what we've assumed is that there's no supply response, or it's very, very limited. And that actually is quite a sensible assumption to make, because we already have animals on farm. They're already in calf or in lamb, most likely already, looking towards the spring of next year in terms of the production side on animal systems. Crops are already being sown with a view to harvest next year. So a lot of the decisions that farmers have had to make have already been made and are kind of baked into terms of the supply that's coming forward next year in Ireland. And the same thing goes in many other markets. So in the short run, things are very inelastic. The supply is likely to be very limited. So we've assumed that there is effectively no supply response next year. We based our forecast price changes across the different commodity sectors off of our analysis from last year, which I was talking to you about this time last year in terms of the no deal Brexit outcome. Okay, the trade policy changes don't get phased in; they happen overnight at the end of this month if there's no deal, and they will be very abrupt, and they will potentially, for some sectors, be very, very dramatic. Okay, now, myself and colleagues are working on an ongoing basis on updating that analysis, looking again at this UK global tariff schedule, looking at what we might assume will be in a thin trade agreement if we can manage to get one with the UK. So looking at the impact of non-tariff barriers to trade and what that means for Irish agricultural prices and incomes. That analysis isn't yet complete, but once it is, it will be given to government and will be released to the public in due course. Okay. If we have an agreement over the next few days or week, we will be revisiting the analysis that's going to be presented today, and that will be made available to everybody on the Teagasc website. So in the event of a deal, there will be revised forecasts for 2021, and they will be made public in the public domain. Okay. And the final slide I'll just leave you with is just a summary slide of what the tariffs will mean on some of the tariffs in both directions. So what I have here are just a selection of tariff lines for the things that we export to the UK, we being Ireland, from the first 6 rows of this table, and then the bottom 2 rows are cereals which we import quite a lot of those from Britain. And what this slide basically reinforces is that the tariff levels are very, very high. Okay, so we're looking at tariffs close to or in excess of 50% for most meat and dairy commodities, the exception there being pig meat, where the tariffs are a little bit lower at close to 30%. And the tariffs on what we import from the UK in terms of wheat and barley are close to 50% as well. And at kind of conventionally sort of is understood import demand elasticities, those kind of tariff levels will be reflected in dramatically lower volumes of trade between the UK and Ireland, the UK and the European Union. So if we don't have a Brexit deal and tariffs are imposed, there will be big impacts. And even if we get a deal or manage to get a deal in the next few weeks, there will be non-tariff barriers to trade that will also mean that prices most likely will be lower than they would have been because of Brexit. So I will leave it at that, Director, and we can now get into the detail at a sectoral level.
Okay. Thanks a lot, Kevin. And clearly, timing is everything when you're doing a review and outlook. So obviously, Brexit is a huge uncertainty. And just to underline an important point, the no deal is an assumption.
Yep.
It's not what we expect or forecasts will happen. And as Kevin said, when there is clarity around the outcome, we'll be able to come back and reanalyze the implications. So now Fiona Thorne, Dr. Fiona Thorne will deal with the overall situation and outlook regarding agri-inputs, and she'll also focus on the cereal sector. Fiona.
Okay, thank you, Director, for that. Okay, so I'm going to talk to you for the next 15 or 20 minutes about a review and outlook for inputs and crops. So just an overview. For 2020, I'll talk about inputs and crops and where we are now in terms of the farm gate. I'll talk about input costs, yields, price, and then gross and net margin for the cereal enterprise and specialist tillage farms. And again, the same format for 2021 for inputs and crops. And it's all pertaining to where we are in terms of the farm gate. So talking about first about input costs, then yields, price, and gross and net margins. So the review and outlook for inputs, and this is important for setting the scene for all of the commodity presentations which you will hear later on this morning. So a review of the year 2020. The first headline that I want to present here in terms of inputs for 2020 is that for the year as a whole, the price movements have been larger than any volume movements that we have seen in recent years. So for fertilizer, we're looking at downward movement in fertilizer price of 10% for the year as a whole compared to 2019, with volume changes being slightly less at up 3% in aggregate for the year as a whole. Now, it's important to make the point at this stage that the individual commodity presentations and enterprises will have a slightly different take on some of the volume movements in particular. And fuel for the year as a whole, farm gate fuel prices down 10% for the year as a whole, electricity prices down 1%, feed prices for the year as a whole minus 1%, and in aggregate volume up 4%. But again, the individual commodity and enterprise story will have different stories there. But in general, most of the arrows that you see here in this slide are green and they're pointing downwards, so a positive in terms of inputs at the farm level across the commodities. So total costs and direct costs in particular down in 2020 compared to 2019. So if we move forward then to year 2021 and what our forecast is for direct inputs. And I'm starting off with feed. For 2021 for feed, it's minimal price increases that we're forecasting for the year as a whole. So small price increases in 2021 compared to 2020. And what's important to highlight at this stage is that it's the year as a whole, an average across all the months of the year in 2021 compared to 2020. And what belies that average is that the feed price story is really a tale of two halves for the year 2021, with an increase in the first half of 2021. And that is due to a hangover effect from the 2020 decrease in production in the international balance sheet for cereals and strong demand that prevails, particularly in the last quarter of 2019. And that's feeding into an increase in feed prices in the first half of 2021 compared to 2020. But for the second half of 2021, we are forecasting a decrease in cereal prices. Now, this is one particular point that there's very much still uncertainties and production uncertainties around that forecast for the second half of 21. But what we're assuming is that trend yields will occur, and with the increase in winter plantings that we're seeing, particularly across Europe, we are forecasting that that will impact negatively on prices at harvest in 2021. So for the year as a whole, we're forecasting a 3% increase for the year 2021 compared to 20, and feed volume, no change on a per head basis. Next, we're looking at fuel, and Trevor has already set up this story quite nicely in his macro presentation. Again, at the farm level, we're forecasting minimal single-digit price increases for our forecast for 2021. And this is on foot of the forecast and the futures prices that are out there for Brent crude oil at the moment, which are showing little change in 21 compared to 2020. In aggregate, we are forecasting a 3% increase in euro terms at the farm gate, and that's including any increases that will come from carbon taxes in 2021. And it's important to note at this stage that there are slightly higher increases out there in the futures market in US dollar terms, but based on the assumptions, what we're assuming for the exchange rate between the US dollar and the euro, we think that the farm gate fuel price in 2021 will still be minimal, up about 3% for next year compared to 2020. And fertilizer, again, we're forecasting minimal price increases in 2021 compared to 2020. Prices up 5% in aggregate in 2021. And this slight increase of 5% in 21 compared to 2020 is reflecting the slight increase in demand in fertilizer that's prevailing out there at the moment, based on the increase in winter cereal area in the EU in particular. We've seen India returning to tender contracts and tender processes at the moment, all bidding up prices and having an upward movement on fertilizer markets at the moment. It's also, of course, reflecting the slight increase in energy prices that are prevailing for 2021. So in aggregate, prices in the fertilizer market up 5% in 2021 compared to 2020. So we won't recoup all of that, of the 10% decline in fertilizer prices that we saw in 2020 compared to 21. So 5% increase in fertilizer prices. So just in summary for inputs for 2021, the headline is that we'll have slight upward price pressure on inputs in 2021. And all of the colour coding you see here, whether it's red or green, is pertaining to whether it's positive or negative news at the farm gate. So fertiliser prices up 5% in 2021 compared to 2020. And on the volume side, mostly no change, and any differences in that will be outlined in the enterprise presentations later on this morning. Fuel prices up 3% at the farm gate. Electricity price, we're assuming no change at the farm gate. Feed price, because of the tale of two halves for 2021, in aggregate, we're saying prices up 3% next year. Volume, no change, particularly on a per head basis, given total input costs across the commodities, very small increases, but that's a very sector specific story. So just to summarize on the inputs before I move on to the crops review and outlook, the input story for 2021, we're forecasting smaller price changes overall with little volume change per hectare, with some differences at a sector and a whole farm level. We're looking at a forward price for inputs such as feed, fertilizer and seed, all upward price pressure for 2021, and the implications will be a very sector specific story for inputs next year. So to begin the enterprise stories, we're going to begin with crops, given the importance of feed as an input for other sectors. So the crops review and outlook. And just to begin with, I'm going to give you the headline news stories for the year 2020, the year just gone, and overall it's a negative news story. And I think that that won't be anything new news to anybody here listening in today, because we've all heard of the decrease in yields and decrease in production that has prevailed in the tillage sector this year. So in average across all of the cereal crops that predominate here in Ireland, based on the Teagasc harvest report published just there last week, we're looking at an average 11% decrease in crop yields per hectare across the crops that we grow. Coupled with that, there was also a significant decline in cereal area in 2020 compared to 2019. When we put together the decrease in yields per hectare and the decrease in winter cereal area, it gives us a 20% decrease in cereal production in 2020 compared to 2019. But on the other side of that, there was an increase in cereal prices at harvest time between 10 and 20%, depending on the crop that you're looking at. So a slight positive there to counteract some of the volume decrease. Another positive across specialist tillage farms, we saw an 8% decrease in costs due to the input story that I've already outlined, and also due to the fact that we had the increase in spring cereal planting, which in itself is less input needy as a crop. So putting all of this information together, we had a 15% decrease in gross margins, and then taking off our overhead or our fixed costs off those gross margins, leading us to an €80 approximately decrease in net margin of the average cereal enterprise and specialist tillage farms in 2020. And again, in 2020, quite a significant proportion of our specialist tillage farms earning a negative return from the marketplace, with 50% of cereal farms estimated to earn a negative from the marketplace in 2020. So just looking at that in a little bit more detail across our main cereal enterprises, here we're looking at spring barley, winter wheat and winter barley. And on average here, we're looking at gross margin decrease between 2019 and 2020 of 15%. So the decrease in yields was not negated by any increases that we saw in cereal and straw prices. And this is on foot of the negative news story that we heard this time last year in 2019, where margins were already severely depressed in 2019 on cereal enterprises. In 2020, we're looking at spring barley down by about €90 per hectare, and winter barley and winter wheat down by 70 and €30 per hectare, respectively. Now, this is just based on an average across all cereal enterprises in our Teagasc National Farm Survey. But we all know that there's a large variability around those margins, and that's what I want to present to you here in this next slide. And we're moving from gross margin here now to net margin, and we're splitting our sample of specialist tillage farms within the Teagasc National Farm Survey into 1/3 groupings based on how they perform in relation to net margin. So on the left-hand side of this graphic here, we're looking at the bottom 1/3 performers for the average cereal enterprise and specialist tillage farms in 2019 and 2020 estimate. Then in the average, we have our moderate margin farms, and on the right-hand side, the top 1/3 of farms in terms of their cereal enterprise and net margin on a euro per hectare basis. What we're seeing here is that there was a decline in the cereal enterprise net margin in 2020 of about €75 per hectare on the moderate margin farms. But again, in 2020, we have a significant amount of our farms earning a negative return from the marketplace. And the variability around that is that our low margin farms, our estimate for 2020 is that they will earn a negative to the tune of about €400 per hectare in 2020, compared to about €380 in 2019. Our high margin farms having a return from the cereal enterprise of about €300 per hectare in 2020. But again, quite a large amount of our specialist tillage farms earning a negative from the marketplace in 2020. So now looking forward to our forecast to 2021 for the cereal enterprise. And based on our calculations for 2021, there are a number of items that we need to deal with. And the first that we're going to look at is what our forecast is for yields for the year 2021 for cereals and specialist tillage farms. But before we get to the 2021 yields and production story, we need to look backwards a little bit to inform our assumptions. So for the year just gone and the harvest of 2020, we saw a decrease in production and stocks, not just in Ireland, but globally and in the EU in particular. And this is what you see here in the graphic on the right-hand side. So a decline in production in stocks of grain in 2020. And this production in volume terms also made its way into the stock-to-use ratio internationally in 2020. And this was due to the decrease in EU wheat production in particular, a 7% decrease in aggregate in EU grains, and then that fed into a decrease in the EU stocks of wheat and maize, leading to an increase in wheat and barley prices at harvest 2020. So the question we ask ourselves now is, do we think that the 2020 global harvest will be replicated in 2021? And the information that we have to hand at the moment is that we have seen a significant increase in winter cereal plantings across the EU, and we're also assuming a return to trend yields in 2021 with higher yield potential. So overall, this is leading us to an assumption that the 2021 harvest will mean production levels to increase. So that leads us on to the next item that we need to take into consideration, which is price. And based on the futures markets which are prevailing at the moment, and we're looking here at the 2021 forecast for futures wheat price at harvest next year. And it's important to make that point that I'm talking about the harvest price of next September here. And what the futures market is telling us at the moment, that the supply side conditions are weighing heavily on futures markets, which means that that will translate into a 5% decrease in harvest prices for 21 compared to 2020. Now, futures markets are prevailing upwards for about the first 6 months of 2021 compared to 2020. But when we get to harvest time and next year's production volumes come into play, futures markets are forecasting a decline in harvest prices next year by about 5% is what our forecast is. But we always say that futures doesn't always get it right, and this is what this graph here is showing us, is that there's an upper and a lower bound on that forecast based on how right and how wrong the futures market has got it over the last 15 to 20 years. And the highest level that our economic modelling is telling us that next year's harvest price could go to is 240 per tonne and a low of 140 a tonne. But with the best economic modelling that we have at the moment, next year's harvest price to be down by about 5% next year. But I've said that the futures market doesn't always get it right. But based on the information that we have at the moment, the futures price is just slightly to the left of midfield, which is portrayed here in this graphic. So it's a slightly bearish set of consequences for 2021. But we say the futures market doesn't always get it right, and there are some pluses and some minuses that could play out for the year 2021 at harvest time. On the left-hand side, those bearish factors which could play on the futures market is information that we have to hand at the moment. A return to trend yields and an increase in winter cereal area all play negatively on futures prices for next harvest. But on the more bullish side and on the more positive side, the sentiment that's out there, those factors that could impact prices positively include weather woes such as El Nino, which is coming into effect this year, trade negotiations and the impact that that would have on imported price, exchange rates, because all cereal grains tend to be denominated in US dollar terms, and any impact that that would have could be positive for the year 2021. Loyalty bonuses in the last couple of years have come into play and have had a positive effect on cereal prices at harvest, and any grain quality or moisture levels could have a positive effect on prices next year. But overall, a slightly negative impact on prices for 2021. And the final element that we need to take into consideration is cost. And overall, the direct costs on cereal farms to increase by about 2% in 2021 compared to 2020. And that's based on fertilizer prices being up, seed prices being up, fuel up 3%, and crop protection up by the hardy annual of 1%, showing overall direct costs to increase by about 2% for our major cereal crops. So finally, we get to margins for our forecast for 2021, and across the board, we're forecasting an increase in gross and net margins for our cereal enterprises next year. Gross margin per hectare to increase by €10 per hectare for spring barley, and winter wheat and winter barley to increase by 125 and €50 per hectare respectively. A lot of what is governing these increases in gross margin is based on the yield projections that we're using for next year based on 5-year trend yields. And finally, we're looking at net margins here, again, based on the 1/3 groupings. In general, a slight upward movement in net margins for 2021, a net margin per hectare forecast to increase by about €40 per hectare in 2021, leaving quite a significant number of our cereal enterprises earning a negative return from the marketplace next year. So in summary, our 2021 crops forecast. Well, first of all, we saw the prices. The probability is that prices will decrease slightly at harvest 2021 by about 5%. but there is very much a lot of uncertainties around that 2021 price at the present. We're assuming a reversion to trend yields, which will mean that there will be an increase in yields across the board, costs to increase by an average 2%, meaning that overall there will be an increase in gross and net margins in 2021, but the average cereal-based net margin will still struggle to be positive next year. And that concludes the presentation for cereals for 2021.
Fiona, and I think it's a very sobering presentation for the sector, and clearly it's facing huge challenges. I just want to remind our audience again to keep your questions coming in. As I say, at 11 o'clock, we'll have an opportunity to address some of them. So our next speaker is Michael McKeown, who works in our pigs development department. So over to you, Michael.
Thank you very much, Jerry. Okay, ladies and gentlemen, you're very welcome. I'm just giving you a quick overview of the pig sector here in Ireland. For those who are not familiar with it, just a few very quick stats on it, on exports, on herd size analysis, and on the contribution to rural employment. Look at exports, first of all. In 2019, the estimated exports were 941 million, which is a very sizable figure. If you went back 10 years ago, our exports were about 314 million. So over the last 10 years, exports have increased by about 300%, which is a sizable amount. If you break it down on a per pig unit there, it will work down for each pig unit there, it's worth about 3.5 million per unit in the country. So where do these exports go? 45% roughly going to the UK, and about 25% now are going to the Chinese market. And this has been increasing over the last 3 or 4 years very, very strongly. We just look at the herd size analysis. In the country, we have 1,641 active herds that have a herd number. But if we look at it on the basis of how many of these are a commercial herd, it's a much smaller amount. We have about 265 herds that are integrated herds, which means they bring the pig from birth the whole way to sale. And then we've about 55 herds that are only for finisher pigs alone. Average size herd in the country is 574 sows approximately. And last stat then, just on rural employment. The pig industry, because it employs a number of operatives both on farm and associated industries, makes a valuable contribution to the economy. Overall, about 8,000 people employed. On farm, that works about 1,200 people, and associated industries 6,800. Okay, that's a quick overview. Looking back at 2020 at the pig sector, we look at the composite cost of pig feed. So pig feed is about 70%, 65-70% of the cost of producing a pig. So we can see the trend here over the last 12 months from January the whole way to December, and an average then for the year, which we estimate will be 305 euros a tonne. And that's feed that is bought from the compound mills. If we look at this on a cent per kilo basis, we can see there obviously the same trend. And we estimate then on a cent per kilo basis there, it'll come in at 108 cents. What happened to the pig price during the year? Again, same trend. We were on a high last January, really high trend. We were hitting about €2 a kilo because of the Chinese market, which we'll speak about later on. But unfortunately, due to COVID, as COVID started to cause a number of logistical problems, both for transport, for factories, for processing, for lockdown, we saw the pig price sliding there, and has been sliding there for the rest of the year. Overall, though, it's still a very healthy 173 average for the year on a cent per kilo basis. If we look at the trend just on the pig price over the last number of years, we can see there in 2018, the price trend was very, very flat. As we went into 2019, after the first quarter, we can see the Chinese effect there, where they really started to import a huge amount of pig meat all across the world, and that rose prices, our prices and European prices. And then unfortunately then For 2020 then, we start to see the price slip as we discussed. Our margin over feed for 2020 has been 65 cent. And if we look at that compared to the 5-year average of 52 cent, it is significantly above the 5-year average, and it has been a very healthy year for pig producers. For 2019 and 2020, the profitability in the sector has been very good. We look at this on an EBITDA scale. We can see on a cent per kilo basis, it's been about 22 cent a kilo. On a pig basis, it's just a little over 19 euros a pig. And on an average size unit of 574 sows, it equates to nearly 300,000 of a margin. So it has been a very successful year for pig producers. And in general, the sector is in a very healthy state. Looking forward to 2021, we've seen that declining pig prices, and that's going to be an issue as well for 2021. If we look at pig price, first of all, it's based on 4 main factors on the Chinese market: ASF, which is African swine fever, which is similar to foot and mouth disease. The other 2 factors then obviously are the Brexit, as we've discussed already, and COVID. This is the Chinese market, and this is an interesting graph. What you see here is the percentage of Chinese imports as a percentage of global trade. So the bottom line here is you can see the chicken there as a percentage of global trade, followed by seafood, followed by beef, and then for pork. So you can see here at the pork at the moment is 45% of the total global trade. So the Chinese market is huge for pig meat production, not just in Ireland, but across Europe and even in the US as well. They have a huge effect on the global market. Going back to 2018, if they had an outbreak of African swine fever, and this meant that they had to cull up a huge percentage of their sows. And if you look at that from, it was about 19 million sows. So the equivalent of that is if you got all of the US herd, the EU herd, and the Canadian herd, and you liquidated the whole herd, that is the same amount as the Chinese had to cull because of African swine fever. Over the last 2 years, the recovery has been huge. The Chinese government have invested about 26 billion in the last 2 years for new pig units. So they're trying to move the old style sort of backyard systems off the east coast here from the heavily populated areas, and they're trying to move them up to the grain belt areas up here and into the interior to provide some rural employment. Because at the moment there's 70 to 80 million people are moving from the countryside to the cities every year looking for employment. So the Chinese government see the pig sector as a way of trying to slow that movement of people down. It'll be the end of 2021 before they start to get to the pre-2018 levels of about 80 to 85% of the herd size that they had before. So this means that during the year, their pig price is going to cool, and as a result of that, the level of exports from Ireland to China will decrease slightly. We're saying something about minus 10% is our best guess on that. Moving on. This just is showing the pig meats to China over the last number of years from 2015 up to 2019. You can see in 2019 it was worth 180 million. We think it'll be similar in 2020, and it's about 90,000 tons. So as I said, it's a very significant market for us. Moving on then to the effect of African swine fever on Irish pig prices as well. For those of you who aren't familiar, it spread first of all from Russia. It moved into Eastern Europe and was spread by wild boars. And since September, it has moved into Germany. And they now have had 185 cases of wild boars with African swine fever in Germany. This is important for 2 reasons. One, Germany are the second biggest producer of pig meat. And the other issue is as well that China is their third. The German exports to China are their third biggest source of pig meat into the Chinese market. So even for the Chinese, it's the German pig sector is very important as well. As a result of that, the German pig meat has to be sold within the EU, and that is causing problems for other markets like the Italian ham market and UK market, where they're seeing a price decrease. Just mentioned COVID very briefly. It caused logistical problems for the pig sector, both due to transmission within the slaughter plants from person to person. It also caused a shipment issue in that when the Chinese economy was shut down last February and March, all of the refrigerated reefers got stuck over in the ports. About 60% of the global amount of refrigerated containers were stuck on the Chinese side. So it took about 6 weeks for them to come back after the Chinese their economy opened. So that caused logistical problems on our side here. Also, some of the pig slaughter plants that have got COVID have lost their export license to China, and that's caused a backlog of pigs. We're seeing that at the moment on the Danish market there, where they have to roll about 120,000 pigs each week at the moment because they lost their export license from a number of their key plants. The outlook is a bit more optimistic because the UK have indicated that they think that slaughter plants now are a key logistical supply chain, and that they're not going to close the plants if they can at all. They're going to try and manage, if there is an issue in the plants, they're going to try and manage it within the plants. And the other issue is that there is some discussion on whether food chain workers should be in the front of the queue for vaccines for the human COVID vaccine if it does come about. Brexit, we've mentioned that already. It's important for us, for the pig meat trade. As I said, about 45% of our exports. It's worth about 500 million a year to the pig sector in Ireland. And the other issue is that about 12% of the pigs that are born in the Republic of Ireland are slaughtered up in Northern Ireland, up in mainly in the Cookstown plant. So it has logistical issues as well. However, the UK is about 40 to 45% self-sufficient in their pig meat. So they are going to have to import a certain amount of pig meat. And again, look, will they set the tariffs at zero, or will they set the tariffs higher, or all of that is all up in the air at the moment, as we mentioned. Just looking quickly at the pig feed, and Fiona has covered a lot of this ground already, so I'm not going to replow it. Just to look at the four main ingredients for pig feed is soybean, wheat, barley, and maize. The soybean harvest was very poor in the US. So they had a decrease in their closing stocks there, and this will affect the safety buffer that we will have in 2021. The Brazilian crop had been expected to be 133 million tons. I don't think it's going to happen because there's late planting there, and due to poor the planting conditions and the amount of drought they have due to lack of rain there, I can't see them actually achieving this level. The other issues there is that US-Chinese were having obviously a trade war. The Chinese were importing a huge amount of their soybean from South America. In fact, they imported so much that they ran out of soybean there, and they've had to import a load from the US, which is the first time in about 25 years that has had to happen. So a shipment had to go from the US down to Brazil, which is like bringing sand to the Arabs. As a result of that, the recent price increase there of 420 euros a ton will be sustained there for most of 2021. However, most of the Irish producers who are home milling have locked in the soybean price probably at about 330 to 40 euros a ton. In July 2020, you could have locked in for the whole year at about 327 euros a ton. So a lot of producers who are home milling have done that, fortunately. You can see here very, very quickly, just the line here is the amount of moisture that the soybean crop in Brazil needs. This is the amount it's actually got. So you can see the deficit there is quite high, and this is the amount of rain that they've got there in the last 10 days. So they have got some rain, but it's been very, very low. So that's why I think that the crop is going to have difficulties and the yield won't be as high. Wheat and barley, again, I'm just going to breeze through this. Fiona has mentioned the problems that was in 2019. That resulted in the current high prices for the pig sector there of wheat about 225 euros a ton, a barley of 205 euros a ton, and this would likely be sustained into the first and second quarter of 2021, with a risk even of the wheat supply getting much tighter in the spring, all depending on the ruminant trade if the cow herd and ruminant herd are out in grass early and it's an early spring, it'll reduce the pressure. But if not, then we could see the wheat getting a little bit tighter. Overall, though, the Australian output is looking really, really good at about 29 million tons, apologies, up from about 15 last year. So that's a 14 million ton of an increase. And overall, as Fiona mentioned, we think that the harvest price will fall by 5 to 10% from where it is at the moment. Maize, again, the same. Soybean had problems in the US, but since then it is about to start replanting. The South American soybean planting there has gone. The soybean planting is late, so therefore the maize planting will also be late because they plant maize after soybean. And the other issue there is that the Chinese used huge amounts of the stocks in the springtime when they were locked down, and they're trying to replenish their stocks there at the moment, and the pig herd is also increasing. So we think overall that the current price of €215 a ton will be the same for Q1 and Q2. Just to summarize then, what's that going to mean for pig price and for feed price? We think that the pig price for 2021 is going to be 159 cent per kilo, and the feed price would be much the same at 109 cent there for 2021. So the margin over feed is going to be much tighter. Thank you very much for your attention. I'll pass you back to the chairman.
Thanks a lot, Michael. And that was really, really interesting. I think particularly your comments and analysis of the Chinese market is remarkable. I mean, I remember, when we first heard of the African swine fever, the expectation was it would take 5 years for the Chinese to recover from the massive culling. And from what you're saying now, at the end of next year, up to 85% of the pre-2018 herd re-established. That is really extraordinary, and it shows how the Chinese are so capable of mobilizing resources when they really need to. And I think that's a lesson for other sectors as well. Just to remind people again, please use the chat function if you have any questions for any of our speakers. And I'm now going to move on to Tom Houlihan, who's a forester and a forestry specialist. So Tom is going to give us an overview of the review and outlook for the forestry sector. Tom.
Okay, good morning to everybody. And as Jerry said, my name is Tom Houlihan, working within the Forestry Development Department in Teagasc. And this morning, we will look at some of the key forestry issues arising during 2020 and also look to 2021. "2020 has been a year with some serious challenges within the forestry sector in Ireland, and this presentation will consider annual planting levels, indicative forestry returns in 2020, timber demand and supply situation, and trends in timber prices. And looking to 2021, we will cover some of the main challenges and opportunities, including some Brexit implications, before some final messages. New planting in 2020 is projected to be approximately 2,350 hectares. And unfortunately, this continues a recent declining trend and is just over 25% of the 8,000 hectare target set out in the Climate Action Plan. So I think this frames the extent of the challenge for 2021 and beyond. 2021 has been a year during which the reported intensification of delays in issuing of forestry licenses has seriously challenged the sector, with well-documented impacts for afforestation, forest road construction, and timber harvesting. The Department of Agriculture, Food and the Marine have implemented a series of actions targeted at improving the licensing system. These include enactment of the Forestry Miscellaneous Provisions Act, introduction of fees for application submissions and appeals, additional staffing resources, the recent appointment of Ms. Jo O'Hara to advise on implementation of measures within the McKinnon report, and the recent convening of a wide-ranging forest policy group by Minister of State Pippa Hackett. Feedback from the sector highlights the urgent need to substantially increase the flow of afforestation approvals to support the 2020-2021 planting programme. The industry is reliant on a continuous flow of approvals through the licensing system, and a functioning industry is needed to support forest owners also. There is also a need to support farmers and landowners in terms of engaging or re-engaging with the forestry option as a viable and complementary land use, and building confidence on the merits of planting. And we think, given the correct signals and supports, farmers will be willing to plant in the future. This slide provides an indicative comparison of forest returns for 1 hectare of a mainly broadleaf and conifer forest. The broadleaf species on the left is sycamore, which reflects grant and premium category 5 on a 50-year assumed rotation, with 15% of the area set aside for biodiversity enhancement, or ABEs as we call them, which are required for all new forests. And the conifer species is Sitka spruce, grant and premium category 3, with a 33-year rotation and standard requirements of 15% broadleaves as well as 15% ABE. The Teagasc Forestry Investment Valuation Estimator, which we call 5 for short, uses discounted cash flow analysis to bring expected future revenues, shown here in green, and future costs, with examples in red, back to today's values using an assumed discount rate of 5%. This discounting allows the calculation of the net present value, which is, for the broadleaf example, is almost €6,000 per hectare. And in order to allow indicative comparisons of forestry with other farming enterprises, this 5 tool allows different forest crop rotations to be expressed on an annual per hectare basis by generating what we call the annual equivalent value, or AEV, for each forest scenario. The AEV expresses the net present value as a series of equal cash flows over the forest life cycle. So we see here that the indicative AEV for a mainly broadleaf forest is €326 per hectare per annum. If we compare this with a mainly conifer forest, the conifer AEV is significantly higher at over €500 per hectare per annum. And if all costs and returns associated with forestry land use are compared with all costs and revenues associated with agricultural land use, then the per hectare forestry AEV and the family farm income can be conceptually equivalent. So on that basis, the forestry returns indicated here can be competitive when compared, and I stress at an indicative level, to some agricultural enterprises. This graph shows the Coford forecast of net realizable roundwood volumes potentially available to end users up to 2035. It includes the potential supply from state and privately owned forests in Northern Ireland, seen here at the base. The Creelta supply forecast is shown in orange, and the private forest supply from the Republic of Ireland in red. And in green, we have the total net realizable volume at the top. This forecasted private volume increases from 1.36 million cubic meters in 2021 to 2.86 million by 2025, at which stage the private supply will be equivalent to the Cuilta potential supply shown by the intersection of the two curves. And post 2025, any significant increase in the roundwood supply, as you can see, is forecast to come almost exclusively from privately owned forestry in Ireland. Realizing this future supply will be critical to the sustenance and expansion of the farm forestry sector, as well as the supply chains and the processing sectors. And an updated COFOR timber supply forecast is being prepared, and it will be expected in Q1 2021. And if we look briefly at the recent top destinations for forestry exports, we can see that the UK is by far the most significant and will continue to be a crucial market for timber in the future from Ireland. Just briefly looking at timber supply, and domestic timber supply was increasingly restricted during 2020 due to the aforementioned backlogs in licensing, and the graph shows the monthly felling licenses issued in 2019 compared to 2020. So since April, May, COVID-19 restrictions, depleting timber stocks from both the privately owned and Cuilta forests have seriously challenged the sector. It necessitated the importation of timber logs, with some processors reporting weekly boatloads of timber from Scotland to fill timber supply deficits. The price of log imports has also increased significantly due to buoyant demand in 2020 from European timber. In 2019, the timber volumes that were harvested due to bark beetle infestation in Europe caused market oversupply issues. However, global wood markets report significant increased supply of these logs to fill China's current demand. And the US experienced a reported pandemic-driven home DIY boom, which has provided additional export outlets during 2020. This additional market buoyancy has been challenging for timber imports to Ireland in terms of both availability and in terms of price. So in terms of looking at prices, in this slide, we'll briefly look at timber prices and the strong price trends during 2020, reflecting the supply shortages of timber that prevailed. The table on the right shows the average log size categories that we have used for simplicity in this analysis. So looking at Cuilta, and the prices are not available for Q1 2020 as no auction took place, but Cuilta timber prices show an upward trend for both sawlog and palletwood categories, as represented here, over Q2 and Q3 in 2020. In addition, a rise of approximately 30% in price is evident when average prices for the third quarters of 2019 and 2020 are compared. Prices arising from private timber sales are available for each quarter through the Wood Price Quarterly, which is collated by University College Dublin in conjunction with the Irish Timber Growers Association. And analysis of price trends for private sales can be more difficult due to limited sales and some gaps in assortment categories. However, a general trend of increasing category prices is evident between Q2 and Q3 2020, which reflects the trend in Cuilta prices also. So just moving to some Brexit issues, and again, some of these have been covered already, but regardless of the outcome of Brexit negotiations, the end of the transition period will bring changes for companies importing or exporting to Britain, bringing additional customs requirements on goods, including timber and timber products from the 1st of January. So for example, exporters will need to declare goods being transported by hauliers with a customs declaration form, Documentary identity and physical checks will form part of these new requirements. New commodity codes will apply to timber products being traded, and Irish exporters will require an economic operator registration and identification number. A further requirement is that businesses will need to plan for customs declarations duties. Businesses will need to consider how they administer the sale of goods and services across borders, as well as planning for any potential VAT implications, due diligence requirements, and any potential administrative burdens. And an important area is wood packaging, and wood packaging material, which includes pallets, crates, and dunnage, which are essential for the transport of many goods moving from Ireland to the UK, is not required to meet current obligations under the International Phytosanitary Plant Health Measure, which we call ISPM number 15. But in a no-deal situation, all wood packaging material moving between the UK and the EU will be required to meet this standard through heat treatment. And under the UK global tariff, most wood products would remain duty-free. However, as we see here in the table, panel products such as particle board, oriented strand board, and medium density fiber board would attract a 6% duty, with a reported capacity to significantly undermine competitiveness. So for example, in 2019, Ireland supplied 31% of the fiber board and 14% of the particle board imported to the UK. A further challenge would be the effect on the euro-sterling exchange rates, as a predicted decline in sterling against the euro in a no-deal scenario would have implications back along the timber supply chain. And as a high proportion of Irish forest products are exported to the UK, as we've seen previously, any disruption to supply chains would likely to have anticipated knock-on impacts for the sector. And finally, looking at the economic and construction activity, and an October survey of UK construction companies indicates a degree of optimism for the next 12 months. However, the UK Timber Trade Federation also highlights that there's an uncertain nature of a continued economic recovery, and they point to a comprehensive trade agreement as one of the best ways forward. So I suppose to summarize here and look at the 2021 outlook, and feedback from the sector points to the urgent need for a flow of licenses as the top priority, and a real concern in that it is essential to support the viability of the forest and forest products industry, which provides essential employment in rural economies. This flow of licenses is seen as critical to ambitions for new forest planting, forest road construction, and timber mobilization. And supporting farmers and landowners in re-engaging with the farm forestry option will play an important role. Also, supporting forest owners to promote sustainable forest management requires a continued and innovative response to research, knowledge sharing, and training. There is a need to progress forest certification groupings, and this is coming into sharp focus to allow continued access to future markets and to foster competitive advantage. Housing completions are currently projected at between 20 and 21,000 in Ireland. And from a timber demand perspective, despite the serious challenges, Ireland is well positioned geographically to capitalize on existing and future market opportunities in the UK, which imports 7 million cubic meters of sawnwood and nearly 3.7 million cubic meters of wood-based panels in 2019. And recent engagement with timber processors indicates a positivity that challenges can be met and timber markets can be grown. However, this is contingent on a sustainable flow of timber from our forests. And finally, the structure of the new CAP continues to be negotiated, but it provides opportunities for the sector going forward with issues such as alignment of forestry and agricultural schemes being a focus. So to finish, I would like to highlight one of a range of ongoing initiatives undertaken by Teagasc in conjunction with the Forestry Division of the Department of Agriculture, Food and the Marine. And this initiative is a national photography competition entitled Celebrating Our Forests, comprising 4 fortnightly teams. And the competition, I'm glad to say, has generated great interest. My final slide shows the winning photo for each of the 4 teams, and the overall winner of our photo competition will be announced on December the 8th. So with that, I thank you for your attention and hand you back to Professor Boyle.
Thanks a lot, Tom. And I think your presentation really demonstrated the dual role of forestry in the agricultural economy. Clearly, as an important enterprise that generates, as you point out, a very competitive return compared with most other enterprises, other than dairy, of course. I think that's a very important point that needs to be continually emphasized. But of course, in recent years, we now recognize the hugely important additional benefit of forestry as a carbon sink. And unfortunately, as you point out there, I think you could only call the reduction, the continued reduction in plantings as, being quite alarming, especially if we look forward to what's going to happen post 2030. The potential of the forestry sector to act as a carbon sink will be severely impaired. So clearly, I mean, we're all conscious. It's something that's very much on the radar as far as policymakers is concerned. And the other point, I guess, that's important is the point you make about the role of Brexit and the significance of the UK market. Okay, ladies and gentlemen, now we've made exceptionally good time, and we're going to take an opportunity now before we move on to a detailed consideration of the remaining enterprises, beef, sheep and dairy. And then, of course, we will have an overview of the sustainability challenges that impact on all of the enterprises. And then Trevor will draw everything together in a presentation on what this all means for overall farm incomes. So what I propose to do now is take some questions that have come in. And again, I remind everyone for the next sessions to use the chat function. But we have already got a couple of questions. And the first one I'm going to is for Trevor, and it relates to the assumptions implicit in his macroeconomic forecasts, and in particular, the questioner asks, to what extent has the Biden election being built into the forecasts? Trevor, do you want to take on that easy question?
Sure. I was relying to a considerable extent for these macro data on the ESRI. So the data I used in the presentation are related to their quarterly economic commentary produced in September, and I wouldn't have had any view as to who was going to win the US election at that time. So no, that's not something that has been factored in, nor was it factored in at the time that we would enter a second lockdown, for example, in this country. So when they do produce their revised estimates in later this month, that will be a factor. I guess there's a few things have happened actually really between their last release and the one that's imminent. One of those, obviously, as I mentioned, is the lockdown, which will have had a little bit more depressing impact on the domestic economy here. But on the flip side of that, the exporting sectors are continue to perform very well, and in fact better, I think, have performed better of late than I think the SRI had even forecast. So when you weigh those factors up, it may well be that their estimate for the contraction in the economy for this year will not be very different to the numbers I just showed you. Taking the kind of short-term outlook, we are till 2021. I'm not convinced that the choice of the American president is going to play an enormous role in the short term. I think maybe from an Irish perspective as well, and this is my speculation, we could be a bit naive in imagining that one president is good for Ireland and another one is necessarily bad. In the end of the day, as somebody said, countries don't have friends; they have interests. I'm sure that this new incoming administration will have its own interests from a US perspective. They may not be as oriented towards the America First agenda, and they may be more an internationalist administration. But I think it's going to take a while for that to have an impact on the international scene. So that would be my take on that.
Okay, thanks, Trevor. And I would have thought anyway, the way the polls were going in the run-up to the election, I would say a Biden win probably had been factored into the expectations to some extent. It's very interesting now if you look at what's happening in the States recently, particularly in the stock market. It appears that the earlier than anticipated announcement of the COVID vaccines has really been a key factor in boosting the stock market and expectations for the future, rather than the presidency, the outcome of the presidential elections. But look, when you're dealing in this kind of a space, certainly it's highly speculative. We've got another question, Kevin, for you from Joe Curtin, and it concerns the nature of the tariffs in a no-deal situation. Actually, I really think that slide you put up there certainly is the one that I always come back to, that information on the tariff schedule. But the question is that, are those tariffs in the event of a no deal, are they fixed for a period, or could they be subject to change?
Well, they're the tariff. They're the bound tariffs, so they're the maximum tariffs that the UK that have notified to the WTO and to its members that they will apply in the event of no deal. But the tariffs that they choose to apply can be lower than those bound levels. So those are in some sense the maxima that could apply. Now, the nature of the tariffs that the European Union and the UK will apply on agriculture and food products in particular can be quite complicated, and for many tariff lines include an ad valorem part, a tariff, and a specific tariff. And that means that the ad valorem equivalent, or when you turn it into percentage terms, it depends on the value of the trade flow. So those AVEs, or ad valorem equivalents, were calculated using 2019 data. If prices change, those AVEs for many of those products will actually change too. But they are prohibitive tariffs, and they're designed to be prohibitive because they're designed to basically exclude imports from markets. If the UK applies the global tariff like they said they will in the event of a no deal, it would exclude imports from the UK market for many of the commodities that the UK is actually a major net importer of, such as beef, lamb, pig meat. And the result of that would be that wholesale prices, at least in the UK, would go up quite dramatically. Now that wouldn't be fully transmitted into consumer prices that consumers in the UK will face, but consumer prices for food almost certainly would also go up. And then comes back to the UK government in terms of how they balance the interests of British consumers relative to British producers, in terms of how they might, in a political decision, choose to apply a lower tariff regime than the one that they've announced to the world that they will apply in the event of no deal. But they will be WTO members in good standing, and if they apply a lower tariff schedule, it'll have to be on an MFN, most favored nation basis, so that everybody gets access to those those lower tariffs. And in the event that we have a deal, and this is a question came in from Teagasc Conifrey from the central bank, you know, there will still be additional trade costs on trade between the European Union and the UK, and between Ireland and the UK. The difficulty is that we don't know what those are, because they will depend on how costly it is for firms to comply with customs regulations, how costly it is for them to comply with sanitary and phytosanitary regulations that they'll have to have, export certificates and health certificates on their agri-food exports to the UK and vice versa from the UK into the European Union. It'll depend on how hard it is to get through the eye of the needle in terms of the Dover-Calais crossing, in terms of getting through the southeast of England. So it really is a kind of a difficult knot to untangle. There are lots of econometric-based estimates of what those NTBs might be, these non-tariff barriers. And we're working in the moment in trying to do an analysis of the trade deal outcome that we hope will happen, based on some assumptions from the literature on those non-tariff barriers. But they, generally speaking, most estimates are that those NTBs are a lot lower than the tariffs that apply to agri-food trade. So while they will negatively affect import demand and negatively affect agricultural prices, the impact is likely to be a lot smaller than the impacts of a no-deal Brexit. Just for example,
yeah. Sorry, Kevin. Yes.
No, just like the beef, the deboned fresh beef tariff that the UK has announced to the world is prohibitive, and it's 12% plus 253 British pounds per 100 kilograms, and that's 60% ad valorem equivalent at the 2019 values. And if you have an import demand elasticity of 2, which is very, very low in trade terms, that trade just will not happen at those kind of tariffs. And that's really what makes this prospect so damaging for the Irish agricultural sector. Thank you.
Thanks, Kevin. That was an answer of great clarity and detail. I remember when I was studying trade theory a long time ago, my professor used to refer to non-tariff barriers as with the analogy that when you drain this beautiful placid-looking lake on the surface, you drained out the water, you saw all the ugly rocks, tree stumps, and all the dangers underneath. I thought it was very good.
Yep.
And I think we're going to hear an awful lot about non-tariff barriers, and hopefully, I'm still confident there will be a deal, but there's really very little focus on the NTBs, and I think there will be hopefully when we do have the shape of a deal emerging. We have a question here for Fiona, and it concerns whether Fiona would like to elaborate on the uncertainty around surrounding cereal prices for the year ahead. Okay. Fiona, have you some comments on that, please?
Yeah, thanks, Director. So what I've done in the paper and in the presentation this morning is that I've worked off the futures prices that are prevailing there at the moment in euro terms. And if you look up the website from yesterday, AHDB, you've seen futures prices prevailing lower next harvest than they are spot at the moment, or lower spot prices back September or October time. But on the positive side of things, there is a lot of commentary out there at the moment about bullish type factors which could bring up that price. And they are actually prevailing for the first half of 2021 as it stands at the moment. And though they're particularly related to sort of weather conditions in particular geographical regions, which are important for cereal and grain production internationally. So that El Nino effect, which Michael McKeown went into detail on, is a very real concern. Also in Russia, what sort of snow cover is there for the cereal that is in the ground. And if there isn't enough snow cover there, that would have a negative impact on production levels and an upward effect on price. So any of those sort of weather concerns that are out there at the moment would have more of a positive effect on cereal prices than what the futures is predicting at the moment. But the best that we can do is work off those future prices, and they are real prices that are out there at the moment, that cereal farmers are getting text messages off their merchant every other day offering them those prices. So they're real prices that farmers can take into effect at the moment. And that is a negative in terms of their harvest price for next year. But look, we live in hope maybe that those weather concerns do come through in other parts of the world. But at the moment, that 5% is what we're working off. Now that 5% also bakes in that no deal Brexit that Kevin talked about, and because we're a net importer of cereals into this country, the no deal situation and the tariffs that Kevin outlined would mean that imports of cereals into this country from the UK would be prohibitive if those tariffs apply. So we have to look at alternative sources for our imported cereals in that case. So it's additional transport costs that we're looking at. So that 5% decline could be minus 10% if we got a deal situation. So the cereals is a little bit different than say the beef sector or the milk sector.
Okay, thanks Fiona. And very briefly, a question for Tom Houlihan. Tom, the questioner wants to know, does the annual equivalent value, or the AEV, does that include the forestry premium? Tom?
Yes, it does. It does is the sharp answer, in that it's derived from the net present value. And I suppose the first thing would be that it's important to say that we're looking here at indicative comparisons when I present that analysis, because we're looking at a future stream of costs and returns in forestry, which we bring back our discount to today's value, and that gives you your net present value. And then you apply a formula which provides the annual equivalent of that. So it includes all returns such as annual premia, returns from thinnings, and a final harvest where applicable. And it also includes the costs. So the answer is yes, we try and include them all.
As another professor of mine used to say, there's a complicated mathematical formula underlying the calculation of the AEV. But as Tom said earlier, it's roughly equivalent to what we call family farm income for all of the enterprises. That includes any direct payments or premia, and it's the very same in this situation. So to emphasize the point Tom made, the AEV is, you can think of it as the family farm income equivalent. So you could compare that then to other enterprises, roughly, bearing in mind forestry is a very long-lived product, unlike most agricultural products. So that has to be borne in mind. There's obviously more uncertainty when you're looking that far into the future, although the forest premium provides uncertainty for up to 15 years. Isn't that right, Tom? Provides certainty in terms of it. Yeah, and that's a very important factor to bear in mind. Okay, we have a few other questions, but I propose at this stage we stick to our schedule and we'll take them at the end of the session. And now we're moving on to consideration of, first of all, the cattle enterprise, and Jason Lockery from our Rural Economy and Development Programme will make a presentation on the cattle sector. Jason.
Okay, thank you, Director. So I'm going to provide the situation and outlook for the cattle sector. And I'd first like to give a shout out to my colleagues who have organized the virtual beef conference, which takes place this evening at 8 p.m. And you can register on the Teagasc website for that event. It takes place tomorrow night and also on Thursday evening at 8. So this is work with Dr. Kevin Hanrahan and concerning the beef sector. It's been a challenging year for the beef sector, just like other parts of the economy. We've had volatility. But in the end, the average steer price is up by about 1%. Heifer prices down slightly. Young bull prices continued poor performance in 2020. Farmers selling cattle in the marts have done well. Winning prices are up 5%, store prices up less so. So the age of the animal and weight category important. Sorry, I've small issue there. So a challenging year for the beef sector. Cattle prices up in the marts, but up only slightly for finished animals. Input costs decreased. In particular, this is important for cattle finishers. Gross margins are up on cattle rearing by 11%, down slightly in cattle finishing. Overall, the average cattle enterprise net margin is still negative in 2020. The BES payment has contributed to the situation of cattle rearing farms, and on average, it provides a reward of 44 euros per hectare in 2020. It contains both mandatory and optional actions. In terms of mandatory actions, the first is the payment to weigh each cow-calf pairing, and a payment of 50 euros provided to weigh the first 10 pairings before winning time, and 40 euro for other cow-calf pairings up to 100 calves. So this continues on and builds upon the pilot scheme, the original pilot scheme. BPS introduces the further actions. Action 2, payment of 30 euro per cow-calf pairing. So meal feeding around winning time, which has proved very popular. Most adopters have chosen this option. Vaccination for respiratory diseases was also an option, which would have provided 30 euro per cow-calf pairing. Fewer farms have adopted this one, although it's a very important factor in animal health. Action 3 is a payment of 10 euro per cow-calf pairing, targeting liver fluke. And again, this is quite popular, this third action, providing just 10 euro per cow-calf pairing, but very popular. BFP payments, beef finisher payments are an important component of income on cattle finishing farms in 2020. These were introduced to counteract the impact of COVID-19, the major shock to farm incomes, beef prices in particular, during April, May, June. The actual spend is 46.6 million. That money has been issued. So a boost to gross output for cattle finishing farms to compensate for poor prices, essentially. On average, cattle rearing farms are up significantly in 2020, and they have restored level gross margin to the levels observed in 2017. So 472 euro per hectare in 2020 is the average gross margin estimate. Gross output is up 4%, gross margin is up 11%. Average net margin has improved significantly from minus 85 euro per hectare in 2019 to minus 28 euro in 2020. And there will be quite a degree of variability between farms in this category. Some farms will have positive net margin, while others will remain negative. Participation in the BBS and BDGP programs is an important determinant of where farms fall in the ranking. Cattle finishing, in the case of cattle finishing, gross output is down slightly. Gross output is made up of both cattle sales and cattle purchases. Cattle purchase prices are up significantly in 2020, while finished prices are just up slightly, and this was also highlighted in the recent beef budget analysis by Teagasc. Gross margin is down slightly by 3%. On average, there's a little movement in the overall net margin, so still remaining negative on average in 2020. Expenditure levels fall slightly on cattle rearing farms by about just 1% really. There are some additional costs associated with adopting the BBS program, around weighing cattle and so on. But little movement elsewhere. Motor fuel costs are down. We assume no change in overheads. On cattle finishing farms, we can be more confident about what has happened on input expenditures. Concentrate feed costs are down on average, and there are some changes elsewhere, including again, motor fuel costs are down. Overall, total costs down by 2%. Beef prices are volatile in 2020. As you can see here, there's a comparison of 2020 with 2019. You can see that for recent months, prices are higher in 2020 relative to 2019. Autumn finishers have done a little bit better in 2020 relative to 2019. So it depends on when you sold your cattle in 2020. The EFP payments did compensate farmers for poor prices during the spring and early summer. Going back to 2018, prices are still 5% lower than 2018 over the course of the year. You can see there that the gaps through time. What determines beef supply? Beef supply and beef demand are the important components that drive prices at the farm level. And at an EU level, you can see that, well, beef supply is influenced by both dairy and beef cows. And over time, you see there has been a significant decline in the dairy cow population in recent years. You can see that even at the national level in France, Netherlands, Italy, Germany, and other EU member states. You see a decline in the dairy cow population, increasing yields, other factors as well. Beef cow population has remained largely constant, only small declines in the last few years. Coupled payments are an important factor to consider there. So gross output is made up of volume and prices. And production volume in 2020 was actually higher than 2019, approximately 1% higher for prime cattle. That's steers, heifers, young bulls, 1% higher. The weights are up in 2020, so overall production is well up. But the COVID-19 did have a significant impact on production, particular points during the year, driven by the situation in the European food service sector and so on. This is an important pie chart. Cannot emphasize this enough. On the left-hand side, beef exports and the share going to each destination. You can see here the UK accounting for 47% of beef exports in 2020, rest of the world up to 16%. It's up from 11% the previous year. And you can see here the Netherlands, where there's quite a high consumption of Irish beef in the Netherlands. France remains important, and other EU countries as well. But this is why we are in a risky situation. We have 47% of our beef exports going to the UK. Live exports are down slightly in 2020. Some increase in the number of store animals, finished animals leaving the country. So Kevin has outlined the UK global tariff schedule and has alerted us to the scale of the problem that could potentially arise from a no trade deal outcome scenario. First of all, I'm going to speak about the input side. It looks like, as Fiona alluded to, there's going to be an increase in feed prices. In previous crises, we have seen this before, where feed prices actually go up. Little movement elsewhere in the overall input expenditures in a no trade deal scenario. In a no trade deal scenario, there are significant declines in output prices. And this comes about because exports, which were previously destined to the United Kingdom, are no longer competitive under the current UK global tariff schedule. Current exports are no longer competitive and must be redirected elsewhere. So, the factory Ireland model, our estimate is, our forecast is, that steer prices will decline by 19%, and this would filter through to also through to younger cattle prices. This would have huge implications, enormous implications for gross margins in both cattle rearing and cattle finishing enterprises. So in the region of 36% decline in gross margin in cattle rearing, and 41% decline in the case of cattle finishing. To illustrate this further, we look at take out the average, just highlight the average margins in 2021 for both enterprises, both in terms of gross margin and net margin. You see here major declines in 2021. So we've had challenges in the beef sector in recent years. This would, in the event that this scenario of a no trade deal outcome would far exceed all those recent challenges. So what happens if we do actually have a trade deal? We very much hope that this will be the scenario, even at this late stage. But still, COVID-19 will place some downward pressure on the food service sector. Now, this will probably be offset largely by what happens on the retail side, but the food service sector is important because of where we export to, and this will remain important. UK and EU beef production are set to decline in 2021, and this is a positive in the event of a trade deal scenario. We think that overall beef production will remain fairly similar. Prime beef production may be down slightly, but overall beef production will probably be similar in 2021. And do take into account the fact that weights can be important, not just number of animals. Increase in input costs seems likely. Exchange rates, we don't know. Various speculations about what might happen in the event of a trade deal scenario, but you have to take into account there could be volatility as well as anything else. Non-tariff barriers, as Kevin has alluded to, will bring difficulties and introduce new costs in the supply chain. A rise in the export share to the EU is likely in 2021 and into the next few years. It seems likely. If you look at the export values, consumer prices, and so on, things are a bit better in the EU in terms of the opportunities than we're sometimes led to believe. So I think a rise in the export share to EU member states, other EU 27, appears likely. So in conclusion, again, COVID-19, important, 2020. Cattle rearing incomes are up, cattle other, largely unchanged. There's variability within that product category. Coupled payments were very important. Prices in the markets, good relative to recent years. 2021, there's a significant risk of a no trade deal scenario. Various institutions will come up with probabilities around what, even at this late stage, about what might happen, but we don't know. No trade deal incomes fall by up to 40% under the Forestry model. That's their forecast. Even under a thin trade deal, there's still costs to consider, non-tariff barriers. EU and UK production declines, which is good for us. EU export share can increase and is likely to increase over the next number of years. And there are opportunities there. COVID-19, the situation is improving with the vaccine, but it's a very large scale operation, and there's some uncertainty there as well. So thank you very much.
Thank you, Jason. And I think clearly Jason has pointed out that one sector that would be very severely affected by a no deal is, of course, the beef sector. And I'm sure it's an issue that will come up in question time as to how producers can respond. But I guess it's also important to point out that the collapse would be from a very low base as well, so there's an ongoing profitability issue with this sector, hence the importance of direct payments. But also another very important point for this sector is the role of part-time farming. Many of these beef producers are part-time farmers, so the prospects for the general economy and the implications of the COVID vaccine for the health of the general economy is very important to many farm households in the beef sector. So thanks very much, Jason. We now move on to a review and outlook of the sheep sector, and that will be given by Anne Kinsella. Over to you, Anne.
Sorry, I just have lost my screen there. Can you hear me?
Yes, and we have your screen. We see a beautiful photograph, I assume, from the west of Ireland with very content sheep.
Just hold on, I'll just stop sharing for a second because I just cannot start the videos for some reason.
Your video is working now.
No, yeah, thank you. Apologies about that. Good morning to all of you.
No problem, Anne.
Tuning in here this morning. We're going to continue our review and outlook for the dry stock sector, and now I'm going to move on to the outlook for the sheep sector. And I would like to firstly acknowledge my co-author on this paper, Kevin Hanrahan. And also, as per Kevin's presentation earlier, we're assuming a no-deal Brexit for the sheep sector in this analysis. In this presentation, the mid-season lowland lamb enterprise is used to analyse the financial performance of Irish sheep farms, as it is the predominant lowland sheep system in Ireland, and only farms with greater than 20 breeding ewes are included. However, for financial and technical data on the hill sheep sector, may I ask you to please refer to Table B in the appendix of the sheep paper. And over the coming months, we will be publishing additional analysis and details of the hill sheep system. So first of all, we're going to begin here with a summary review of the financial performance of these mid-season lowland farms for the current year. So for 2020, gross margins per hectare for the lowland lamb producers are estimated to have increased by 43% on average in 2020 to just under €900 per hectare, while net margins increased by 191%, almost doubling year on year. And in absolute terms, these net margins increased from €113 to €328 per hectare in 2020. Higher marketed output values, which were up 19% on average, resulted in these higher margins for this sheep system. And with Irish lamb prices significantly ahead of 2019 prices, reflecting higher prices in the EU for heavy lambs, input expenditure was also slightly higher, particularly feed input costs, which were up 7% year on year. And this was mainly as a result of increase in the volume of purchased feed used as concentrate as feed prices were down. Gross output was also boosted by the receipt of payments from the sheep welfare scheme, and coupled with the above, this is estimated to have resulted in higher margins on the average lamb enterprise, up 43% on average. So now we're going to review this input spend a little bit more closely. Total direct costs for this enterprise were up slightly in 2020, up about 1% on average. And if we take a little closer look at some of these direct cost components, in particular those that are highlighted on the graph, the feed concentrate and pasture and forage. Purchased feed typically accounts for about 40% of total direct input expenditure on the average lowland system. So it's the most important cost for this sector. And in 2020, feed concentrate costs increased by 7%. And this was mainly by increased volume that drove this increase, as volume increased by 8% year on year, while the feed price actually declined by about 1%. Pasture and forage costs typically account about 30% of the direct costs for this system. And in 2020, these costs decreased by 7% compared to 2019. Pasture and forage costs comprise of fertilizer and contract costs. And while fertilizer prices were estimated to have decreased in 2020 by 10%, the volume used is estimated to have increased slightly by about 2%. And if we look at the bar chart on the right-hand side of the screen, we see that average sheep production costs for 2020 in comparison with earlier years are shown. And this highlights that the 2020 year total production costs are in line with previous year's production costs. So now we're going to move on and focus on the global situation, moving from Ireland to global sheep meat markets. And we look at global trade in sheep meat markets, and we can see that it has grown by over 40% since 1990, as illustrated on the graph on the right-hand side of the screen, which shows lamb exports between the years 1990 and 2019, which was sourced from the OECD. Throughout this period, international trade has been dominated by Australia and New Zealand, which are the first and second largest sheep meat exporters globally. And in 2019 year alone, Australia and New Zealand accounted for more than 2/3 of the value of global sheep meat exports. And driving the global sheep meat story further is the relatively new trader on the block, in the sheep sector. It's China, and the emergence of China continues to change the dynamic of the global sheep meat market, as China is now the largest producer, consumer, and importer of sheep meat. Increased exports of sheep meat from New Zealand and Australia to China means that China is absorbing the Australia and New Zealand supplies into the EU market, and thus less of it is competing with Irish lamb in prime markets, which of course is good for Irish sheep farmers. However, with Brexit looming, improvements in lamb prices in the EU may attract New Zealand lamb back into the EU market. And this will very much depend on the EU price relative to China, and if the price differential is enough for New Zealand to start exporting into the EU market. And the tariff rate quota resolution may leave New Zealand with a big tariff rate quota into the EU market, but we will have to wait and see in that regard. So now we're going to switch our attention back to Ireland, focusing on Irish sheep and lamb meat exports. And as we know, the bulk of Irish sheep meat production is destined for foreign markets. And in 2019, 55,000 tonnes, that is over 3/4 of Irish sheep meat production, was exported. And the reliance on the export market means that understanding likely lamb price developments on Ireland's export markets is critical in assessing the prices that Irish sheep farmers are likely to receive for their output. And illustrated on the pie chart on the bottom left-hand side of the screen, continental EU markets account for the majority of Irish sheep lamb exports, and about 1/3 of all exports are destined for the French market, as shown in the blue segment of the pie chart. And although France still remains the most important sheep meat export destination, it now comprises a lower share of volume exports than in earlier years. And if we look at this data on a year-to-year basis, total exports are up substantially, up about 40% on average. And exports to the UK accounted for an estimated 22% of Irish exports on a year-to-year basis, and were up 17% from the previous year. So that the UK continued to constitute a most important export destination for Irish lamb. So now if we switch our focus and look at the story for Irish lamb in the 2020 year, we will firstly look at the graph on the left-hand side of the slide, which shows the evolution of heavy lamb prices in the EU. And we concentrate firstly on the current year, which is shown as the blue line on the graph for the 2020 year. The EU market was characterized by much higher prices that persisted right throughout the year. And prices were supported by a steady EU demand, and which was the principal driver of these higher EU prices. Average prices were also well ahead of average prices for the 5-year period 2015 to 2019, which is shown as the grey line on the graph. And in recent weeks, EU prices have remained strong, and comparisons of November prices show that current prices are higher than they were for the same period in 2019. And for the year as a whole will be about 10% higher than the previous year. And now if we look at the Irish lamb price, which is shown on the right-hand side of the graph, prices began strongly, and for the first quarter of the year were up 5% on average over the same period in 2019. By the second quarter, prices continued the upward trajectory and were 11% ahead of 2019 price levels. The higher Irish price reflects higher prices in the EU for heavy lamb, which are forecast to persist over the remainder of the year. And the seasonal reduction in lamb prices that would usually be underway at this stage of the year has not happened in the 2020 year, and so that it is somewhat unusual in that regard. It is expected that average Irish prices for the year as a whole will be well ahead of 2019 prices, so that our estimate is that the Irish lamb price will be 9% higher in the 2020 year. So if we move on to look at the slaughter story, the sheep throughput was up 5% in 2020. And for comparison, we show monthly sheep slaughter data for the years 2018 and 2019 also. Irish sheep throughput for the year as a whole was up 5%, with over 2.42 million heads of sheep slaughtered. And the number of ewes slaughtered for the year to date is 5% lower. And the cumulative percentage of lamb, hoggets and spring lambs were up 5% and 7% respectively, which takes us to look at the outlook for the sheep sector in 2021. But just before I move to looking at the 2021 forecasts, it should be borne in mind that when we discuss sheep enterprise margins, we are not only discussing enterprise margins for sheep on specialist sheep farms, but on farms that have both cattle and sheep. So hence, if we look at the latest Teagasc National Farm Survey results, we note that on average, only 52% of market-based gross output on the mainly sheep system farms actually comes from sheep. While the mid-season enterprise data analysed for this presentation represents over 9,800 farms nationally, only 1,200 of these farms had 100% sheep livestock units. So when we look at the percentage of sheep livestock units and those farms with sheep gross margin per hectare, we note that no positive correlation exists between those with the highest gross margins per hectare and with regard to the percentage of sheep livestock units. And in fact, the highest sheep gross margin occurred on farms with the lowest percentage of sheep livestock units when expressed as a percentage of total livestock units on a per farm basis. So that on most of sheep farms, cattle, sheep and other livestock cohabit and happily and more than well. So I just wanted to draw your attention to that before I continue on, seeing that as sheep margins are so positive, we just need to be cognizant of the fact that a lot of the farms have both sheep and cattle. So looking ahead at the forecast for 2021, total costs for the mid-season enterprise are forecast to increase 2% on average in 2021. And if we now take a closer look at some of these direct cost components, the outlook for input expenditure from the perspective of sheep farmers is not quite as positive as in 2020, with prices of key inputs forecast to increase, albeit small increases. So we will firstly focus on feed concentrates. As mentioned earlier, these typically count about 40% of total direct input expenditure for this enterprise, so are a very important cost. Feed concentrate prices are forecast to increase by 3%, while the volume of feed used is forecast to remain comparable with 2020 levels. Overall expenditure on concentrates is therefore forecast to increase by 3%. The price of fertilizer is forecast to increase, while expenditure on contract charges are expected to remain relatively stable. So that overall pasture and forage costs are forecast to increase by an average of 5% in 2021. And from the graph on the right-hand side, we can see that based on these expenditure forecasts for 2021, total production costs will remain relatively on par with earlier years. So what is our assessment for gross margins in 2021? Our assessment is that output per hectare in 2021 will increase by about 7% relative to the level estimated for the previous year. Continental markets account for the majority of Irish lamb, and although economic disruptions from the pandemic continue to impact consumer demand, solid fundamentals continue to support demand for Irish sheep and lamb meat exports. And given the positive outlook for lamb prices in 2021, the average gross margin earned is forecast to increase 9% on average to €976 per hectare. Margins earned in this system will continue to be boosted by the receipt of the coupled sheep welfare scheme payment. And with increased output value and total overhead costs forecast to increase marginally, net margin per hectare are expected to increase by 23% to €404 per hectare. And in absolute terms, they will increase from €328 to €404 per hectare. But we must not lose sight within the mid-season system. And in part, this range in profitability is reflective of differing agronomic conditions, such as soil quality, which can limit the capacity of some farms to increase their intensity of production. So if we classify farms on the basis of gross margin and net margins per hectare, that is the best performing 1/3 of farms, the middle 1/3 and the bottom 1/3, then how do the various grouping perform if we apply our estimates for 2020 and our forecasts for 2021? Due to higher stocking and weaning rates and other factors, the gross margin per hectare on the top farms is almost 6 times higher compared to their counterparts in the bottom group. So while the gross margin is forecast to be €976 per hectare on average, a 9% increase, this differs across the groups. Likewise for net margin, which are forecast to increase by 23% to €404 per hectare. While the key story is the cross-sectional differences in profitability, for the 2020 and 2021 years, another story also emerges when we look especially at the bottom net margin group, where negative net margins persisted up until the 2019 year. But this bottom group has a forecasted net margin per hectare, which are now positive for the 2020 and 2021 years, which is indeed a very positive and welcome news for the sheep sector. So this positive sheep margin story, which is forecast to continue into the 2021 year, provides some food for thought for sheep farmers that are not specialist sheep farmers. Many farms have both sheep and cattle enterprises, as I alluded to earlier, and this traditional enterprise mix was more the norm a few decades ago. However, we should not lose sight as to why this traditional mixed farming model changed for so many farmers. And this was mainly due to facilitate the uptake of an off-farm job, so as to supplement family farm income. Indeed, for the 2019 year, just over a half of mainly sheep system farms on the Teagasc National Farm Survey have an off-farm job. Labour requirements on sheep farms also need to be taken into consideration, with sheep farmers requiring just over one family labour unit, while on cattle farms, the labour unit equivalent requirement is somewhat less than one labour unit. Also, one needs to consider some of the barriers to entry to sheep farming and the knowledge gaps that may exist, so that the transition from one farming system to the other is not one that can be taken in the shorter term and needs to be given careful consideration in relation to the factors as listed and also in relation to farmers' own lifestyle preferences. And so to summarise the 2021 year, which is forecast an even better year for sheep farmers. With a stable EU sheep meat production and EU market situation and positive lamb prices, these all result in an increase in output value in 2021. While feed use will remain stable, prices are expected to increase by 3%. Other direct costs will increase by about 2% on average. With the forecast 5% increase in pasture and forage costs, coupled with a 1% decline in total costs, the forecast is that gross margins earned by the average mid-season lamb enterprise in 2021 will increase 9% on average to €976 per hectare, while net margins will increase to €404 per hectare, so that the 2021 year is forecast on average an even better year for sheep farmers. Thank you for your attention, and I will now hand you over to the Director. Thank you.
Thanks a lot, Anne. And I think it's great to hear such a really positive promotion for the sheep enterprise. And it's been consistently shown from the analysis that Kevin Hanrahan and Trevor Donnell and others have done in regards to Brexit. It's the one sector where you can see a positive outcome, even though modest, from a no-deal scenario. And then I thought there was some fantastic information there in your presentation. Not least, you drew attention to the fact that over 50% or 52% of output comes from sheep on most farms. And so its characteristic is primarily one of a mixed enterprise, usually with cattle. And of course, we know from Teagasc research that the combination of sheep and cattle leads to a very efficient use of grassland. And finally, if I might give a plug for the work that our colleagues, advisory and research colleagues, are doing in Athenry. Obviously, you can catch that work on the website, and hopefully in the not too distant future into the new year, we'll have open days for sheep farmers again at Athenry. So thanks again. And now Trevor Donnellan will be dealing with the dairy sector. Trevor, over to you. And by the way, can I remind everyone to use the chat function, get in your questions. We'll have an opportunity for a good discussion at the end of the presentations. Thank you. Trevor.
Okay, we're coming now to the final of the systems that we're going to examine as part of the outlook. A reminder that we have a focus on sustainability coming up next, and then finally a summary of the income situation across the systems. So moving now to dairy, just briefly the format I'm going to take here. I'm going to look at the domestic and international situation, focusing on production, prices, input expenditure, and ultimately taking things down to the dairy enterprise net margin, and doing that for 2020 and 2021. If we begin first with a look at production. I've updated this slide in just the last few minutes because the CSO have just released their October data for milk deliveries, which show a fairly substantial increase of 8% this month, or in October, I should say. But that's to be measured against what was quite a low figure for October of last year. So what are we looking at for the year as a whole? Well, we're seeing a further increase in the size of the dairy cow herd this year of the order of about 4%. And we're going to see a milk production increase of probably in the territory of about 3.5%. The figures for October there may push that number a little bit higher. The fact that the October figure is as high as it was. What that ultimately means is we're looking at a marginal reduction in milk yield this year, perhaps to do with maybe drought conditions that were experienced, or borderline drought conditions that were experienced in some locations during the summertime. Perhaps also there was some concern as we headed into the peak of the season that there might be capacity issues in terms of processing, given the risk that was there at the time of COVID-19 and concerns people have that it would affect staffing in processing facilities. But yeah, I mean, we've seen an increase in the size of the cow herd again, and an increase in milk production, but not really much activity on the yield side this year. Looking more widely at the European Union and UK here, we see for the year to September, EU 27 milk production was up about 1.8%, and the Commission's estimate is that production for the EU 27 should be up about 1.5% for 2020 as a whole, which represents a reasonably strong rate of increase. What was driving that increase? Well, it was a combination of factors. Feed costs were a little bit lower. Against that, in some member states, milk prices were lower, although as we will see in a while, in Ireland, that wasn't the case. And looking at that map and just pulling out from it the more important countries in volume terms from a milk production perspective, we see that Italy, Belgium and Ireland recorded slightly stronger increases than the average, whereas France, Germany and the Netherlands, their increases were a bit on the weaker side compared to the average. But you know, an impressive progression, we'll say, in 2020, considering some of the concerns that were out there at an early point in the year about how the sector would develop over the course of 2020 because of the COVID shock. If we look even further afield at some of the main dairy exporters globally, so we have a chart here, or a table here with the EU 27, New Zealand, US, Australia and Argentina. And what we're looking at here is the annual increase in production in millions of tons from each of those regions. And we can see here that the increase in both the EU 27 and the US is actually almost equivalent, you know, in terms of the tonnage volume at least. The increase in the US is going to be larger in percentage terms, given that the US has a smaller production volume than the European Union. We're seeing also an increase in New Zealand, which seems to, particularly the current production season, which has only begun relatively recently there. We're seeing some quite positive production numbers there. From what we can see, that's largely due to favorable weather rather than any change in herd numbers. So it's a kind of a yield effect, really. We also see a bit of a recovery in Australia, which has had a very dismal experience, I suppose, in recent years in terms of the dairy sector. And equally also a very sizable increase taking place in Argentina in 2020. So overall, collectively, these increases should provide us with the largest increase we've seen in global milk production since 2017. So overall, quite a strong level of growth really from the principal exporting countries. Let's take a look at it for a moment at the price developments, both in terms of dairy product prices and the Irish producer milk price. The area circled here, I hope you can see my arrow here. What we're looking at here, these dips in both the butter and in the skim milk powder price are largely the effect of COVID-19 when that shock emerged. For a period, a few weeks at least, there was extreme concern that this was going to have quite a serious impact on the international dairy market. There was concern in particular that import demand from China would dry up and that we'd end up with quite substantial skim milk powder stock build-up in the European Union. And of course, in the end, none of that actually materialized. The market recovered, particularly in the case of butter, less so in the case of skim milk powder. And the Chinese import demand, while it was slightly reduced, didn't collapse to anything like the extent that some people were actually talking about. You can see the impact of those price reductions in commodity prices over here in terms of the Irish milk price, which did dip for a period. But through the second half of the year, the milk price has recovered. We're looking at actual fat prices here, but even on a standardized fat basis, the price has improved, reflecting the recovery in commodity prices that you can see here. And I suppose the other interesting thing of note is that cheese prices weren't particularly affected at all by the COVID uncertainty. So overall, the price story is actually remarkably good considering some of the concern that existed at one point that we would see significant enough milk price reduction in 2020. So if we look at the dairy enterprise analysis, and I'm merely putting up this chart here to remind people that not every farm has a production cost that equates to the average production cost. We talk a lot about averages in these presentations, and we do it out of convenience and necessity, I suppose, in the sense that we've only a limited amount of time to talk to you about these issues. And there's a huge emphasis in this country on the average cost of milk production. And I guess the message I want to convey in this chart is to remind people that there are very large numbers of farms in this country whose production costs do not equate with the average. If we just look here at 2019, we've split the entire farm population into 3 equal size groups according to their net margin. And we can see here the differential in production costs across those three groups. So you can see here there's a difference probably of about 2 cents either side of the middle group, basically, in terms of production costs. So it's an important thing to remember. Average production costs give us an indication of the direction costs are going, but we shouldn't assume that the individual farms out there have a production cost that equates to the average. So what happened in 2020 in terms of production costs? Not a huge amount, I think, is what we would say. We have seen reductions in some important input items, principally the significant fall in fertilizer prices, which Fiona identified earlier. That shows up then in this reduction in pasture and forage costs. We're looking at costs on a per litre basis here in terms of these percentage changes. The changes on a per hectare basis will be marginally different. A minor reduction also on terms of concentrate feed, with a little bit of a reduction in price offset by a slight increase in volume. Not a whole lot happening in terms of other direct cost items. We see this significant reduction in expenditure on electricity and fuel on a per litre basis, reflective of the significant reduction in fuel prices that took place in 2020. And a little bit of activity on the overhead cost side, plus 2%. That's significant enough because that other overhead cost item is quite a large component of overhead costs. So overall, marginal reduction in production costs of about 2%. We'll see that on a later chart as well. Looking to the right-hand side, I just thought it might maybe highlight a trend that seems to be emerging with respect to feed use per cow that people might want to take note of. A few points of note first. These figures here for 12 and 13 were affected by the fodder crisis at that time, as was the figure for 2018. But if you abstract from 18, 13 and 12, then there is a bit of a trend emerging here of increased feed usage over time. We're going from a situation where we were talking about 800 or 900 kgs of feed per cow to one now where we're talking upwards of 1100 kgs per cow. So that's one of the things that seems to be getting to emerge, I think, in recent years, that there is more feed being used per cow than there was historically. So that increase in milk production that we're seeing per cow is coming from a combination of increased grass utilization and it seems also an increase in feed use. Looking at the overall story for production costs in 2020, you can see we've come down off 2018 levels, which were obviously elevated by the drought conditions. So a bit of a reduction in 19 and a marginal further reduction in 2020. So we're talking about production costs in 2020 of just under 24.5 cents per litre. I have to say as well that the reduction in costs in 2019, these are actual data now for 2019 that we're looking at here. 2020 is an estimate, but the reduction in costs in 2019 is not as large as we had anticipated when we were looking at this 12 months ago. And again, that's feeding into the story that we are using that bit more inputs in terms of individual farms, again reflecting the intensification production on those farms. So if we contrast this period here, I guess, where production costs were coming down quite considerably as milk production increased, we've moved into a period now, I think, where abstracting away even from product prices, or sorry, input prices, the trend is a little bit more upward in terms of production costs. And that decrease we're seeing here, that marginal decrease we're seeing in 2020, that's a price effect rather than a change in the usage volume. So overall, about a net margin in 2020 of about 10.5 cents a litre, which would be about a 5% increase on the 2019 figure. Expressing that in terms of net margin per hectare. We're talking about a net margin per hectare of a little over €1,300 in 2020. And again, as I said earlier, the actual net margin in 2019, back here, is actually lower than what we had anticipated 12 months ago. So the cost of production in 2019 ended up being higher than we felt at the time. So that's just something to keep in mind, that in terms of the development in the net margin. So in 2020, we saw a gross output increase of about 2%. That's that there. Costs, as you can see here, are largely unchanged. And in terms of the net margin, that's a 5% increase there that we're actually looking at. So, summary of 2020, marginal reduction in milk yield, about a 3.5% increase in milk production, a 4% increase in the size of the dairy cow herd in this country. Milk price has remained remarkably stable in the end, even though we did see a little bit of a dip as we came into Q2. Recovery later in the year has left the milk price largely unchanged on last year's level of about 34.4 cents per litre on an actual fat and protein basis. Other positive development from a farmer's perspective is the 2% decrease in production costs, and that's giving us these margin changes here on a per litre and a per hectare basis. So looking to 2021, what can we say? Well, if we abstract away from Brexit concerns, which are more Irish specific, I guess, then the dairy outlook, and this is probably applies across many of the sectors we're interested in, is actually quite stable. We're seeing continuing supply growth in terms of milk production in 21, and that seems like it's going to be matched by a level of demand growth, which should keep prices on international markets relatively stable in terms of dairy commodities. Looking at an Irish perspective, what we do need to do, consistent with our assumptions around Brexit, and a reminder that, especially for those who might be just joining for this session, our assumption is that no deal takes place, and as a result of that, tariffs come into force on the 1st of January. From a dairy perspective, that's principally concern for cheddar exports to the UK. Now, people have been behaving strategically in this regard, and we know anecdotally that there are quite substantial cheese stocks, Irish cheese already in the UK ahead of the 31st of December ending point of the transition agreement. So those stocks being held in the UK are not going to be subject to tariff when they are ultimately marketed. So if we do have a no-deal Brexit, that pushes the headache of what we do with our cheddar production a little bit down the road, or for the first half of the year probably at least. And but it will still be the case ultimately that cheddar that would previously been destined for the UK market may have to be absorbed in other markets and may end up being used in processed cheese production if the UK market isn't available. And ultimately, we factored in a 7% reduction in the Irish milk price in 2021 as a result of that. So that would take the milk price from the 34.4 cent a litre of 2020 back to about 32 cent a litre. Again, that's on an actual constituents VAT inclusive basis. So we are going to see in a no-deal Brexit a negative impact on milk prices in 2021, barring some trade deal emerging. Looking at the cost side for 2021, not a whole lot to say really. There is a little bit of upwards cost pressure, but nothing too dramatic. We're going to see increases in concentrate feed expenditure and pasture and forage costs. Those are largely associated with higher prices for feed and fertilizer. a marginal increase for electricity and fuel, and we actually have a reduction in overhead costs for the dairy enterprise, because more of the overhead costs will be allocated to the other enterprises on the dairy farm. We're looking at an enterprise level analysis here and in this particular example. So that will be why we expect overhead costs to fall marginally. So, you know, feed use per litre we anticipate to be unchanged. We're getting a modest price rise there, giving us that increase in concentrate feed prices. Marginal increase in fertilizer use, perhaps, and again a price rise factored in there also, and minor increase in fuel prices. So overall, we're getting a slight decrease in overhead costs per litre as well. Giving the overall impact on total cost is only a 1% increase. So all of the action next year in the event of a no-deal Brexit is really going to be on the milk price side rather than anything else. Now, looking to 2021, in terms of the average net margin, a decrease, obviously as a result of that, quite a significant decrease of 23%, taking the net margin back to just over €1,000 per hectare. Our assumption is that production would still increase by about 3% next year, and you know that I think that's one that is a little bit uncertain. You know, will we get further cow additions? Probably. Will we get a yield improvement? Other things being equal, you might expect that we would, but the lower milk price might be just enough to discourage farmers from feeding, and there might be a little bit of a pullback in feed use, which might temper the growth in production. I don't think we can be too confident about that. And obviously weather is always a factor here as well, and all we can do is assume normal weather. We're not that good at our jobs that we can tell you whether next year's weather is going to be good, bad, or indifferent. So in summary, 2021, what are we saying? We're saying no increase in milk yield. We're talking about an increase in production, though, driven by an increase in the cow population, a 7% drop in the milk price based on that no-deal Brexit, a marginal increase in the cost of production. And as a result of that, we're losing about 2.5 cents a litre in terms of the net margin, a reduction of 23%. And the reduction as measured on a per hectare basis is of the order of about €300 or 21% in percentage terms. I think that's it. So I'll pass back to our chair. Oh, I have one more slide, sorry. So just to summarize, 2020 was a remarkably uneventful year in spite of the COVID shock that emerged. The story ended up being one more about a fall in input prices because we ended up in a situation where milk prices remained stable, and as a result we saw an increase in margins, and as we will see later, an increase in dairy farm income. Next year is uncertain. The international dairy product market environment looks actually quite stable, but there is a risk of a price reduction emerging in the absence of a free trade agreement with the UK. A little bit of pressure on cost side of things, but nothing major. And because of that milk price decline, quite a significant reduction in the net margin. So now, after that false finish, that is the real finish. So I'll pass it back to our chair.
Thank you. Thank you, Trevor. Just going to remind people again to use the chat function to get in your questions. We'll have an opportunity now after the next two presentations to have a discussion on the papers, on all of the presentations. Just, I think Trevor has pointed out the hazards, I guess, of forecasting. As he said at the beginning of the year, and certainly with the advent of COVID, it was widely anticipated that prices would work out worse than they have done. So at least that's there's a lesson there. But anyway, it's been a reasonably good year for the sector. Just one point to make though, when we talk about production costs in the National Farm Survey and then what Trevor has presented, we're talking about the sum of variable and fixed costs. These costs do not include family labour, and that may be a point Trevor might be able to expand on in the discussion later on. The other thing that would have to concern you a little bit is the uptick in feed use and trend concentrate feed use, which is clearly adding to production costs when obviously the grass alternative is far cheaper. Okay, we're now moving on to our last two presentations. I guess have implications for all sectors, of course. And the first one of those is given by Cathal Buckley, and he will address the topic of sustainability. So over to you, Cathal.
Thank you, Director. Okay, so my presentation is looking at the outlook for sustainability for 2020. By way of overview, I'm going to start with definition of sustainability, talk a little bit through about the methodology or how we estimate some of the emissions in this case, look at the projections for 2020 based on mainly activity data changes, and finish with some summary conclusions at the end. Okay, so what do we mean by sustainability? Well, I've given two definitions there. First, from the Button Commission in '87, essentially it's to meet the needs of the present without compromising the ability of future generations to meet their own needs. Or if you take the Rao and Rogers definition, it's the ability to produce enough food and fiber for the current and future generations without compromising and trying to maximize ecosystem services and functions. So in terms of sustainability of agriculture, what do we mean by sustainable agriculture? Well, essentially nested between economic, environment, social, and innovation dimensions. I kind of like to conceptualize it as a three-legged stool, where you have the economic leg, the social leg, and the environmental leg, and you have the innovation as a stabilizer or wraparound, which keeps the three-legged stool standing. Now, in the interest of time today, I don't have the time to go into all four dimensions. I know Trevor will cover the economic and farm incomes in the following presentation. So in the interest of time, I'm going to focus more on the environmental dimension here today. For anyone who's interested, we recently published two sustainability reports in the last year, one in June, one in the start of November. We're up to date in terms of the time. Most recent data is 2019 National Farm Survey data. And we're publishing across those four dimensions: economic, environmental, social, and innovation, across four domain land-based systems: dairy, cattle, sheep, and tillage. I think for the 2019 year, we published 129 indicators. We were back for over 6 years, 2012 to 2019. And we had 3-year rolling average trends to look at the signal as opposed to the noise in the data. Anyone who's interested there, there's a link there to, in blue, to the web page where we published 5 sustainability reports so far, and they're all on that one web page. The links to them are on that web page for anyone who wants to explore in greater detail any of the other dimensions. So in the most recent sustainability report, we published in the environmental side, on the environmental dimension, on gaseous emissions and risk to water quality. Again, in the interest of time, I'm going to focus more on the gaseous emissions element in this presentation today, specifically looking at greenhouse gas emissions and ammonia emissions from primary agriculture. Why are gaseous emissions important? Well, if you look at the greenhouse gas emissions, almost over a third of our total greenhouse gas emissions from the Republic of Ireland are coming from the agricultural sector. And obviously we have significant targets there under Climate Action Plan, but also under the EU Green Deal to be carbon neutral by 2050. So there are significant challenges there to achieve the objectives we've set ourselves. On the other side of the equation is ammonia. So if you look at ammonia, why is ammonia important? Well, we have targets under the EU National Emissions Ceiling Directive, and 99% of our ammonia emissions in Ireland are coming from the agricultural sector. So essentially there's nowhere else to achieve savings or to achieve reductions. And we're currently in exceedance of that net directive limits. So we have challenges there to bring our agriculture, our systems below that limit on an ongoing basis. Okay, so how do we estimate or calculate farm level emissions? Essentially, it's two components. It's the activity data multiplied by emission factor gives you your farm level emissions. So what do we mean by activity data? Well, essentially, it's what's happening on the ground. It's farm practice. How many animals? What's the number and type of animal a farmer is keeping in terms of dairy cows, sucklers, so on. What kind of chemical fertilizers are volume and type of fertilizer applied? How is the farmer managing their manure in terms of storage and land spreading of that manure? So that's all important activity data in determining the overall level of emissions. We take that activity data and we apply an emission factor. This is more the scientific side of the equation. You know, it's based on field work and lab trials in terms of what's happening. You know, if we use a low emission slurry spreading equipment, or if we spread a certain type of fertilizer, what's the biophysical effect of that? So their emissions, and they're established in long-term trials, and it don't tend to change that radically year on year because science basically until the science catches, until science is published. So when I'm looking at farm level emissions, when I'm looking at projections here, I'm looking at the activity data side of the equation, what's happening on the farm level. Okay, so I said that farm level emissions is a function of emission factors and activity data. So what emission factors are we using here to estimate greenhouse gases and ammonia? Well, on the greenhouse gas side, we're applying the IPCC approach, the Intergovernmental Panel on Climate Change approach. It's how we calculate our national inventories. It's essentially we're replicating what the EPA do at a national level, but we're doing it at a farm scale. So we're using the similar type of approach in terms of emission factors, but we apply it at a more local scale. For ammonia, it's similar. We're using the national inventories approach for all farms. Again, we're replicating the approach to EPA, the Environment Protection Agency, used for reporting our emissions, our national emissions under the EU NEC directive. So essentially, we're using a standardized approach on the farm scale. On the activity data side, we're using activity data from the Teagasc National Farm Survey. It's been conducted since we joined within the EEC in 1972. In recent times, it's a sample of over 850 farms, representing 90% of farms nationally. All these, we're covering about 90% of the land area, and over 90% of the agricultural output with this farm sample. So what type of activity data do we need to engage in this environmental modelling? Because we go well beyond the Teagasc National Farm Survey as part of the EU Farm Accountancy Data Network. We go well beyond what's required under that data network to capture data like what the fertilizers applied, because it's important to know what type as well as the volume and the type, because for example, protected urea has an emission factor 5 times lower than that of straight can. So we need to know the mix of fertilizers being applied on a farm. We need to also know how the farm is managing their manure in terms of housing dates and the volume of slurry that's stored and how it's stored in terms of open or closed scenario, and how it's land spread, is a splash plate or is a trailing shoe, and so on. So all that information is necessary to do our modeling from the activity data side. Okay, so doing our projections for 2020. Two main sources. The first one is animal inventories. Okay, so what's happening with the animal numbers on farm? So I'm using the Central Statistics Office, the June 2019 survey, and comparing it with the June 2020 survey. They publish kind of a snapshot in time of what the level of animals are on farms in June year on year. So it's a kind of a good guide of what's happening in kind of increasing and decreasing the various animal categories. The second main source for projecting forward or for projecting 2020 is the chemical fertilizer sales. So I'm using the sales data recently generated by the Department of Agriculture, and it's a sales year based on September 19th, October 2020. So it's giving us a good guide to what's happening this year versus last year in terms of fertilizer volume sales and type of fertilizers that are sold. When I'm applying the changes in these two sort of activity data sources and applying them to farms in Teagasc National Farm Survey using 2019 as a base year. So we know what's happened in 2019. We're projecting forward 2020 based on these national data sources. Okay, so what's happened on the animal number side from 19 to 20, the June survey, the CSO-based June survey. Okay, so in overall terms, the total cattle numbers have increased by 1.4%, but it's not been uniform across the various categories. So if you look at dairy cows and cattle under 1, 1 years of age, which can be kind of linked to dairy cows. All the majority of the increase is being generated by the dairy sector. So cow numbers and dairy cow numbers going up, and as they're going up, they're generating more calves, and that's been seen from this table. On the cattle side, suckler cows are going down, bulls are going down, cattle 1 to 2 years are going down, whereas cattle 2 years plus got up slightly. But overall, we can see on the cattle side, the numbers are declining. So the overall increase is essentially being driven by increases in the dairy sector. Okay, so what's happening on the chemical fertilizer side? Again, it's a sales data, 18 to 19 versus 19 to 20, based on the sales year of September to October. So overall, in chemical elemental terms, it's gone up by 3.25%. But again, there's some things I'd like to draw your attention to. The straight urea has gone down slightly, and protected urea has increased almost by 81%, by 82%, albeit from a very low base. This is an important trend, an encouraging trend in terms of abatement of ammonia and greenhouse gases. The main fertilizers again are straight can and can-based NPK compounds, and this is where the main increases come. Can up by 0.55%, and the NPK compounds by nearly over 2.9%. So overall, we're seeing an increase in animal numbers and an increase in chemical fertilizer applied. I just wanted to say, in terms of how do we, what does the profile of our NFS farms look like, the national profile? So this essentially, on the left-hand side, this is the categories we report under our national inventory accounting based on the IPCC-based approach. This is the results for 2018, the data, the most recently published data that I have. It basically breaks down the CO2 equivalents and into the categories, whereas how much has been generated by enteric fermentation, manure management, and so on. So you can see there on a national basis, it's 58% from the national profile, and it's 57% in the NFS-based survey. So the point I'm trying to make here is our NFS sample is very closely matching the profile at the national level, which is encouraging from a external validity perspective. Okay, so going into some results then from 16 to 19 with an estimate for 2020. This again is the average for each farm system. The dairy is in blue, cattle in orange, sheep in purple, tillage in green. The diagram on the top left is the yearly average, is the 1 year basis, and the diagram in the bottom is a 3 year rolling average. Why do we do 3 year rolling averages? Because sometimes you can have price or weather shocks, positive or negative, which can influence the year to year on year trends. And the 3 year rolling average tends to smooth out that, gives you more of a signal, takes out some of the noise. So you can see in this case, it's the greenhouse gases on a per hectare basis. I suppose first thing you can see from both the yearly and 3 year rolling average that the greenhouse gases on dairy farms significantly higher than all other systems, and the direction of travel both on the yearly and the 3 year average in the dairy farm emissions are going up on a per hectare basis, whereas in the non-dairy farms, the cattle, sheep and tillage, they tend to be declining, static at best, but declining over the period examined here. Okay, if we interact the environmental with the economic, so if we look at greenhouse gases per euro of gross output generated, the story kind of flips on its head a little bit. Again, the top left is the 1 year average, 1 year basis, and the bottom right is the 3 year rolling average basis. So again, you're getting more volatility on the 1 year basis here because the gross output is fluctuating year on year, particularly on the cattle and sheep side, whereas it's a bit smoother on the bottom diagram, the 3 year average. In terms of the absolute levels, you can see tillage comes out best because it has the lowest level of emissions, and it's the second highest revenue generating capacity. But the cattle and sheep systems come out the worst here because, okay, they have the lower level of absolute emissions, but the revenue generating capacity is quite low. And dairy comes out second best here. Essentially, albeit it has the highest level of absolute emissions, it has a very high revenue generating capacity. And the direction of travel is that the emissions per euro of output is declining on dairy farms. They're generating more gross output relative to the increase in GHG emissions. So the output increase is more than the increase in emissions, whereas the other sectors, relatively static in terms of this metric. Okay, so as you can see from the last couple of slides, like in absolute terms, it's kind of the increases are seen on the dairy side, where the non-dairy side are relatively static. So I want to decompose that dairy sector. What's driving that increase? So okay, we can decompose the dairy emissions into three components. The dairy absolute emissions into three components: kilograms of milk produced per cow, the footprint of that milk, the CO2 footprint of that milk, and the number of cows. So this diagram, or this graph, is showing the output per cow in a standardized of fat and protein corrected milk, standardized at 4% fat, 3.3% protein. Notwithstanding that this year, from 2020 to 2019, there's been a slight decrease in output per cow, but the long-term trend is one of increasing trend. So over the study period, we're looking at the 3-year average indicates that farmers are producing more milk per cow, which is an efficiency gain, which is positive. And that's set to continue. That's set to continue into 2020 in terms of the long-term trend. The carbon footprint of that milk, again, it's a declining trend. So the farmers on a 3-year rolling average basis are seen to be producing milk with a lower carbon footprint. And again, that 3-year trend is seen to be maintained on the 2020 estimate. Here's where the action essentially is, that the absolute emission has been driven by increasing the herd size. And again, we're expecting a 4 to 5% increase in herd size based on the numbers, the June numbers from the CSO. So essentially, the efficiency gains being achieved by an output per cow and carbon footprint are being overridden by the animal demographics. So the herd size is increased faster than the efficiency can catch up, essentially. Okay, final couple of slides, moving to ammonia. It's a similar story to ammonia as it was for greenhouse gases. Dairy farms generating significantly higher levels of ammonia on a per hectare basis, an absolute level. And the direction of travel is quite similar in that the non-dairy sector, the cattle, sheep and tillage, are static, if not declining, generally declining, static at worst. Whereas the dairy sector, their absolute emissions are increasing through time, essentially being driven by the animal demographics as set out before. And again, interacting the ammonia emissions with per euro of output generated, again, with a similar type story. Again, the 1-year average, 1-year basis on top left, the 3-year rolling average bottom right. Tillage farms comes out on, as the best performer, again, lower level of emissions, second highest revenue generating capacity behind dairy. The dairy and sheep, or the cattle, comes out worse essentially because of the second highest level of absolute emissions and has a relatively low revenue generating capacity. The dairy and sheep dinner tend to be kind of tangled in the middle. Essentially, the dairy has a higher level of absolute emissions, but a very high revenue generating capacity to offset that. Whereas the sheep sector has a relatively low level of emissions, but also relatively low level of revenue generating capacity. So one is counterbalancing the other. So two of them end up in the middle between tillage and cattle farms. So in summary, conclusion, on the activity side for 2020, we're seeing, animal numbers are increasing, total animal numbers by 1.4% on the June survey. Again, that's a 2-tier increase because the increase has been driven by the dairy side because the cattle numbers are actually falling. We're seeing an increase in cattle in sale volumes of fertilizer, 3.25% year on year. So again, both are pointing in the upward direction. We're seeing a continued trend in terms of the absolute greenhouse gas and ammonia emissions. We're seeing continued increases on dairy farms. We're seeing the trend, what we're seeing previous years continue to 2020. And other farm systems are remaining static or static at worst and declining generally across the cattle, sheep and tillage farms. Per euro of output, tillage performs best in dairy second, and has lower emissions per euro of output generated compared to the cattle and sheep farms. Ammonia, again, tillage has the lowest emissions, cattle has the highest, and dairy and sheep sandwiched in between. There are some encouraging signs, just to kind of finish on a positive note. We're seeing the sales of protected urea fertilizers increase by 81% year on year, which is an important mitigation option, particularly for ammonia and for greenhouse gases. And I must say that there's a caveat here. I haven't included any figures for low emission stories spreading transitions, because we don't know what the total volume will work out in 2020. But there is some evidence to suggest, anecdotal, that there's a significant transition away from the splash plate method to the low, trading shoe and trading hose, and they're positive signs. Those two farm practices, transition to protected urea and low emission slurry spreading, are the foundation of the Teagasc ammonia and MAC recently published. 80% of the mitigation will be achieved by those two measures. So there's some encouraging signs on that front. So on that basis, I hand you back to the chairperson. My email is there, and for any questions, follow-up questions anyone want to ask, and there's also a link to the Teagasc sustainability reports for anyone who's interested in the wider sustainability set. Thank you.
Thanks a lot, Cathal. And I think, as Cathal says there, if people want to find out more information, the most recent sustainability report produced by Cathal and his colleagues is available on our website. Look, as far as sustainability is concerned, and gaseous emissions in particular, we all know we face challenges, but what's important is that Teagasc research has also pointed the way to solutions. Our final session before questions, and again, a reminder to get in your questions using the chat function, will be presented by Trevor Donnellan, and he'll, if I gather all the various information on the different enterprises together, revenue streams and the expenditure streams, and he'll produce our estimates of farm income for this year and forecasts for next year. Trevor.
Okay, thank you for that. Important to acknowledge that this presentation is the work of everybody that you've seen today presenting, and indeed a few other people in the background who didn't get an opportunity to speak today. Okay, when we get to this point, it's very important that you understand that the analysis that we've been talking about to this point has been what we call enterprise margin analysis. So it's looking at the principal activity on each of the farm types. And that's particularly important for farms that maybe have two enterprises, where one might be the dominant enterprise, but they might still have a significant minor enterprise. And we see that very often, for example, on sheep farms that might have a secondary cattle enterprise, or on cereal farms or tillage farms that might have a secondary cattle enterprise. So that's an important thing to understand, that we're going to be looking at farm level incomes here in the end, and the type of farm we're talking about and how we categorize farms depends on what their dominant output is. And very often these farms may have a secondary form of activity, and we have to take that into consideration as well when we're calculating the farm income for that particular farm type. And we'll see that's particularly important when we come to look at, for example, the 2021 story for sheep farms that we'll see in a while. So, as I say, farms produce multiple outputs, they have multiple enterprises, and we're taking all of those into consideration when we're calculating the farm income for each particular farm type. So we're summing all the margins generated by those enterprises, and we're also adding to those the value of decoupled payments in order to assess the farm incomes. Again, doing it in a more diagrammatic kind of form here, we're talking about our outputs, the price multiplied by the volume, the costs, again, price multiplied by volume, plus the various supports that are available, ultimately giving us our income figure. And that income figure, using the Farm Accountancy Data Network EU definition that we're required to follow, given that the National Farm Survey is a member of that network. That income is a return to land, labour and capital. And because it's a return to labour, this goes back to the specific point that was made earlier, that the unpaid labour, as it's called, the family labour, is not included as a cost item, because the income ultimately is supposed to reward that labour in terms of the way these things are defined. You could choose to define it in a different way, where you put the labour in as a cost, and then your income will obviously just represent the return to land and capital if you so chose to do that. But that's not the way it's done internationally, and that's why we use the approach we use. Just a quick plug for the results of the 2019 National Farm Survey, which are now available, the final results. The preliminary results came out during the summer. Final results are also available. If you need to dig down into the history or the fine detail of any of these sectors, that's where you need to go. The interactive presentation is particularly useful as well, because it allows you to kind of explore the data in charts and click buttons and do all kinds of fancy stuff. So that might be something that is of interest. Moving on to summarize the income story for 2020. These are the price changes we saw across the various sectors in 2020. And keep in mind as well that for many of these sectors, we were also seeing a little bit of a cost saving. And in some sectors, we were also seeing a little bit of a volume increase. Particularly in the case of cereals, we actually saw a volume decrease. So these are just a reminder of the extent of the price changes. Not a whole lot happening on milk, slightly positive in the case of beef, significant enough in the case of lamb, a small increase in the case of pigs ultimately, given that the price moved back over the course of the year, and a significant increase in barley prices, and less so in the case of wheat. But remember, production was down in those systems in 2020. So what did that give us overall in terms of our income story for 2020? Higher beef, pig, lamb and cereal prices, stable milk prices. We see higher volumes of milk, cattle, sheep and pigs in 2020, and a decrease in the case of cereals. So overall, taken together, those price and volume changes on the output side give us an output value increase overall. And on the input side, we're down marginally in terms of input expenditure because we have those price decreases for feed, fertilizer and fuel. And there are some marginal changes on the feed and fertilizer side as well, which were up marginally, which erode some of those price reductions. So the input expenditure in the aggregate is only down marginally. Now, with respect to 2020, we see support payments being broadly in line with what they were in 2019. And if you recall, in 2019, there were exceptional payments made in respect of the upset, which the anticipated Brexit, this was before the transition agreement, if you remember, the anticipated Brexit back in at the end of 2019 led to disruption in the beef market in particular. And there were exceptional payments made to the beef sector in 2019. In 2020, there were exceptional payments made to the beef sector again, this time for disruption relating to COVID-19. So overall, the level of support available to agriculture in 2020 is broadly in line with the 2019 level. I think there might be a 1% difference overall, but only marginally so. So taking all of those things together and using our average National Farm Survey income measure, we reckon that for 2020, the average farm income will be up by about 6% on the 2019 level. Looking ahead to 2021, and again, looking at the same exercise, and remember, our 2021 storyline is dictated by this assumption of a no-deal Brexit, consistent with the government's operating assumption at the moment. So we see price decreases in all sectors, with the exception of lamb, where we see a price increase. And as Anne outlined earlier, that's associated with the fact that the UK would be locked out basically of the EU lamb market, and that would create opportunities for Irish lamb exports into continental Europe. So a tightening basically of the EU lamb market is what would occur and create that price increase. But in other cases, we're seeing price reductions largely attributable to Brexit. In the case of barley and wheat, it's actually more to do with market supply and demand conditions, because similar to lamb, the effect of Brexit would actually be a positive effect on the barley and wheat prices. But because of international supply demand conditions moving against barley and wheat, we still see price reductions for barley and wheat in 2021 under this no deal Brexit assumption. Okay, taking all those together again, what does all that mean for the average farm income? Well, looking at the output prices, as we saw, they're higher for sheep, but down in other sectors. Output volume, we expect that to be up in the case of milk, cereals, and pigs next year. And we expect it to be stable in terms of cattle and sheep. And again, that's an assumption we've made effectively. You might see some supply response next year if prices are down significantly in cattle, but you know, that's a moot point. I think a lot of those production decisions in respect to 2021 are pretty much locked in. So overall, we would see a fairly significant reduction in output value in 2021 under the assumption that there is no deal in respect of Brexit trading arrangements with the UK and the EU. Little bit of an uptick in input expenditure next year due to the price increases we mentioned earlier in respect of feed, fertilizer, and fuel. We're not really expecting too much to happen on the volume side in relation to input usage. Now, in respect of 2021, we've made the assumption that support payments are broadly in line with 2020. And you're going to jump on me here now, somebody in the audience, and say, but what about the exceptional payments that were made in 2020? Are you assuming that they exist again in 2021? And the answer to that is yes, we are. And we're not specifying why those payments might exist or not, but we're trying to keep the analysis as simple as possible here. So we've assumed that the support payments are unchanged in 2021. And effectively, that means there's no Brexit aid assumed. And all it is an assumption, because what we're trying to do here ultimately is to see what size the whole Brexit would create in agricultural income. How big would that hole actually be? We're not saying that the EU or the state wouldn't intervene to some extent to address this reduction in income, but we just want to see how big it is. So it's a thought experiment to some extent to see how much of an income reduction this no deal Brexit would generate. And taking all those factors into consideration, we're talking about an 18% reduction in the average income level in 2021 compared to 2020, with the biggest reductions, as we see here, accruing in the two cattle systems. So you can see here 40% reductions in the income level in cattle rearing and cattle other. So obviously, if there was additional support being provided to the sector, you know, it doesn't take too much insight to understand that these are the sectors where some of that support is going to get channeled. We haven't assumed that for the purposes of the exercise. More modest decrease in dairy income of 13%, but in absolute terms, it's still about €9,000. In spite of the fact that lamb prices would go up under this scenario, because the beef enterprise on these sheep farms is doing badly, we still end up in a situation where the average sheep farm income would decline in 2021. And on the tillage side, what we see is lower prices being offset by a return to more normal yield levels, so an increase in yield, an increase in overall production on these farms, which would ultimately put the tillage sector in a marginally positive situation. So the big story, and this shouldn't be a surprise to anybody given the dependency on the UK from the perspective of the beef trade, is the reduction in cattle incomes. So we're getting a reduction there of that 18%, as mentioned in earlier slides. And I think that's pretty much it. I think just to let people know all of today's content will be available on the Teagasc website. The detailed report in respect of everything you've heard today is up there already. The PowerPoints will be up there later in the day, and I'm sure somebody will get this webinar up onto the website in the next 24 hours as well, for anyone who wants to watch it back in due course. And with that, I'll pass you back to our chair.
Thanks a lot, Trevor. And again, when you put all the various enterprise information together, you can see the potential impact of a no-deal Brexit, with a 40% reduction in incomes on cattle farms and an average overall reduction of 18% or so, which, as you say, if that were to come to pass, it gives some idea of the kind of the ground that have to be made up, so to speak, vis-a-vis transfers to the sector. We have a number of questions in, and I want to thank everyone that has stayed with us, the large number of you, for the duration of today's webinar. And again, to emphasize what Trevor said, the slides and the full report will be available on the Teagasc website over the next 24 hours. So there's a number of questions that I just want to pick up from the session before 11 o'clock that are important to get back to. And I'll just maybe bring a couple of these together. One relates, it's a straightforward question about for Kevin, I guess, on the timeline in relation to Brexit. In other words, when can we expect a decision in respect of the negotiations? And I guess the bigger question then is the number of questions concern the viability challenges that have just been highlighted there in Trevor's presentation, if there is a no deal, and what kind of responses would be possible to alleviate or ameliorate anyway the substantial reductions in beef incomes. So maybe Kevin, if you take the first bit, maybe Trevor, you might take the second, or whatever way you want to mix it.
Well, the timeline, everybody's kind of getting tired of being told that this week is the crunch week, and they seem to be rolling on. But to get through the process of ratification and legal scrubbing, and so that everybody who has to agree and to this deal, if one is reached, so they understand what they're agreeing to, is going to take time, and we are running up against that deadline, and it seems that it's not something that can legally be moved very easily. So I think really this week, or at the very latest next week, is where it's going to have to happen. In terms of the analysis we've done, just to answer the second question, I mean, we have showing an enormous hit in terms of income, and obviously we expect that government and the European Union will respond. They have already got contingency funds in their budgets that they've signaled they are going to use in the event of a no deal. Years ago, 4 or 5 years ago, I was talking at the beef conference, Teagasc Beef Conference, and I was reminding the audience that Brexit is like the dog you get at Christmas. It's not just for Christmas, it's going to be with us for a while. And I think that's an important thing to consider. I mean, I expect that government and the European Union would support farm incomes and incomes in other sectors that are negatively affected by Brexit in the short run. But it's not going to be there forever, that support, so that there will have to be adjustment to this new reality in the event that even in the medium term, the UK and the European Union don't agree a deal, even if they don't get it done in the next week or two. So I expect that there will be income support, and I think that income support almost certainly will not be open-ended. And I know there's been some serious commentators saying that if we have to give income support, we have to have it given in a way that is consistent with our broader policy objectives. And in that context, Cahill's presentation on the environmental performance of Irish agriculture was great to have in the roster today, because if we're going to give support to mitigate the impact of Brexit, we want to make sure that we don't give it in a way that causes more problems, on the environmental dimension. So that'll be an important design feature as government sits down and thinks about how it will attempt to support incomes in the sector.
Okay, thanks very much for that, Kevin. There's actually a question, I think a very important question in regards to the likely increases, or there would be increases in import prices with a no deal. And we don't hear much discussion about this. The specific question here is, what might be the impact on flour prices? Have you any thoughts on that?
The tariff on flour, on wheat flour, is 172 euros per ton. So when you do the calculations off of the trade date in terms of the value of the trade, that's an ad valorem equivalent of 44% using 2019 data. So that'll be the wholesale price impact in terms of the higher prices for flour coming in from the UK, and importers will respond by pushing some of that cost increase onto their consumers, that's you and me, but also by looking for alternative supplies of flour from the continent. Now, that flour is often not quite a perfect substitute for British flour in terms of the breads that we like to eat in Ireland. But some of this, in response to these kind of price changes that will flow from a hard no trade deal Brexit, substitution will take place. So but it will push up the costs of flour. It will push up the cost of the products that flour is used to make, and some of that cost increase will be felt at the consumer level. Maybe not 44%, but it will certainly push. I would expect to push up the price of bread that everybody buys in the shops.
Yeah, there was an interesting interview I heard during the week with Dan O'Brien, and he was making the point that every one of us will be affected by the import prices.
Yeah, we will.
Clearly, the exporters, while it'll be a significant hit, and the farmers, of course, will be fewer in number. So maybe if that were to happen, it'll certainly get a lot of interest and attention. A question here for either maybe for Cathal, but Trevor might want to comment as well. It concerns Cathal, the discussion in the media in recent months about the treatment of biogenic methane. And I guess this has been that discussion has been influenced to some extent by what's happening in New Zealand. Would you care to comment on that, Cathal?
Yeah, I suppose, Doctor, I have been following the debate and the work particularly of Miles Allen in Oxford in this space, where he's proposed an alternative, I suppose, methodology to the global warming potential of methane versus the GWP stars called versus GWP 100, which would kind of change the overall, I suppose, quantity of methane from the herd. But I suppose the metric does hinge on whether the herd is increasing or decreasing or remaining stable. In our case, the herd is, as I see from my presentation, is actually increasing. I'm talking to some colleagues in Lauren Chalou and Gary Lanigan, and saying that it doesn't actually, based on the metric, doesn't make a hill of beans whether you come to one way or the other if the herd is increasing. So it's not a get out of jail free card. We still have to up our game in terms of all the abatement strategies we can bring into play in this space.
Yeah, I'm a member, as you know, ex officio member of the Climate Change Council, and their recommendation is, in the first instance, that methane be separated out from other greenhouse gases. And I think that makes a lot of sense because, scientifically we know it does behave differently in the atmosphere as far as pressure and warming is concerned. But you're absolutely right, Cathal. If the national herd were to increase significantly, that would obviously increase emissions, irrespective of how you actually put an absolute number on the methane production. Trevor, there's a specific question here in relation to dairy farming, or the dairy costs, I should say. And that is that as compliance costs have increased, particularly around derogation, have these been factored into the cost estimates? And if so, how significant are they?
Yeah, it is an issue. I think that's the question from, I think, Kevin from Paul Smith. It's a good question, Paul, and it's one that we really need to delve more into. Kind of reluctant make a stab at it in terms of the estimates for 2020 and 2021. I mean, it'll materialize in two different ways, I guess. I mean, for farmers who go out and actually purchase the machinery required, say, for low emission slurry spreading themselves, then that cost is going to show in and show up as a capital cost that's going to be spread across, 10 or 20 years. So it's not going to show up as a substantial cost, we'll say, on an annual basis. And equally in the other direction, if farmers choose to get that work done by contractors, it will depend, I guess, also on whether they're already contract spreading their slurry or having their slurry being contract spread for them. And, the differential that would be involved in having it contract spread with low emission slurry spreading was not something that I had to hand in terms of doing the calculations for the cost of production for 2020 and 2021. So it is something that we will need to look into and something that we can hopefully extract from the National Farm Survey results themselves, so we can see that explicit impact.
Thanks, Trevor. And of course, when people look to our marginal abatement cost curves, I guess one aspect of those of that analysis that probably didn't get a lot of attention was the fact that was the actual cost of the different measures. I suppose the other point to make, though, if you take less, there are significant benefits to be attached as well in investing in that technology. Final question, because we're very tight on time, and Kevin, really it's a question for you. The question suggests that there will be long-term costs of Brexit, and while the short-term measures may lessen the impact, in the longer run there are significant costs. I presume the speaker is alluding here to the costs of identifying sustainable alternative markets. Very briefly, Kevin, because we're up to the time.
We're over the hour. I mean, yes, there will be, whether we have a deal or not, the hard slog of winning new markets, both in continental Europe, the remaining EU member states, and on the world market, and trying, insofar as we can, to retain market share in the UK will be something that all of industry participants, with the support of Teagasc and Board BIA and the government, will be working hard at doing. But it will be a challenge, and the magnitude of that challenge will just be even greater if we have this no trade deal outcome that we were looking at today.
Okay, I just want to bring matters to a conclusion by thanking all of you for participating in this morning's session, and especially those of you that have asked questions. I want to, of course, thank my own colleagues for the Trojan work they've put in. Some really excellent presentations, excellent slides as well. And to repeat, all of the slides and the full report of today's session will be on our website in the next 24 hours. So with that, just say goodbye and stay safe. Thank you very much.
Thank you. Thank you, Director.
Bye now.
Okay.